What's up, everybody? How's the flooding over there? I went out last night and everything was dry. Good morning. So I don't know how bad it got at its peak, but I stayed inside till like yesterday. My building's kind of on a hill. It's a little elevated from usually doesn't get even even during like the last big tropical storm, it didn't get too bad. How's the flooding over there? You see all the BBBYRQ videos? No. How would I have seen any of them? Good. Yeah. You too, Yaga. Good. Good past noon to you as well. Why was I getting ads for plus size women workout gear? Google's AdSense tailors your results based on your prior search histories. Virginia got nutty but manageable. Watching you from Egypt now. It's 7:30 p.m. here, and the market opens at 4:30 p.m. It's pretty nice, actually. That's kind of cool. Are oil feuds fuck? Crack oil? I don't even know what the fucking ticker is for that on here. Hmm. I have to look it up. Sounds like something Wall Street Bets would care about. GOC. I don't know. Why? All right. So why did BTU Moas over last week? There's a lot of speculation surrounding China getting their shit together and moving to stimulate their economy. And if they do, obviously that's going to be very beneficial for BTU, other coal suppliers as well. So I think spot coal saw a decent climb last week. It may continue to climb if demand through India. Oh yeah, India announced a bunch more coal burning power reactors, and I think China announced putting more of them online. Every share of BTU you buy, the water level in New York City goes up an inch. Yeah, we're not going to stop our dependence on coal anytime soon. Although the technology surrounding coal burning plants has gotten significantly better over the years. Do you want the PR pitch? A rash of sad face BBYRQ videos hit my suggested this weekend. Have you considered that maybe you watch too much crap on YouTube? All of my suggested videos on YouTube are cooking shows. And not like new ones or cooking influencers. It's all just like 2004 episodes of Chopped. Or Serious Eats. So I'm setting SCX less than 4320 by Jan. How dumb am I being? But I don't think that's necessary. I don't know what you mean by setting. But we're already below 4320. How do you feel about PayPal? The same way I felt about it last week. I think it's kind of a pile of shit. A value trap in an industry where, you know, their lack of continued growth is starting to manifest itself in a lower share price. So, I mean, sure, the company's fine, but they have competition and their market share is rapidly decreasing. So all of my suggested videos are VTubers, Girk included. Mine is triathlon stuff, cooking channels, financial stuff, and how it's made. I have HBO, which comes with Discovery Plus, so I don't need to watch my how it's made episodes on YouTube. But I'm glad that you're doing research into your line of work. J&J puts are starting to print again, which is good. Uh, okay, so you're still short J&J? All right, nice. Did KView go up? I should know this because I own some. Nope, nope. I'm definitely buying some. Oh well. Maybe it'll go up by December. I'm in on beautiful clean coal mainly so I can see you punt your way around New York. That could be fun. I've always wondered if I'd lived another life, if I would have been a Venetian gondola driver, captain. Are you a captain when you're? I don't know. Yeah, I'm still in KView. Mine are all ambiance playlists and Pickle Financial. I'm focused in my attentions. Will the government shutdown be avoided because markets to pump a little? Cause markets to pump a little. I'm not really sure. I don't think a 45 day delay is really very bullish, and I don't think the market was pricing in a lot of downside specifically due to the government shutdown. I don't think the market gave a shit. Most of our price action Friday was positional. Maybe, but it's only a 45-day extension. Like it's not a resolution. And then all of the PCE data got revised up. Including Friday's print. So the Friday morning print that was posted at 0.1 had already been revised to 0.2, which is interesting. The Bureau of Labor, BLS, labor statistics, did a big sweeping revision to all of the PCE data going back forever. Turns out it's been wrong all year. It's in fact been much higher. The Fed should have been going way harder, and it's still higher. Which is cool because it makes me feel a little less crazy. And I like that. Spending the last 6 months going, this data's a lie. Everything's way worse than it looks. And then them going, oh, hey, all that data was a lie. This was actually way worse than it looks, is very self-reaffirming. Yes. Sweet validation. Buying yen and YCL, debating on how old boomers in charge of Japan's economic direction are going to mess up the timeline of their intervention. I think they started a 300 billion yen bond buying program for the Japanese notes last week. So they're probably almost out of that money by now. I feel misled. Yeah, that's understandable. Be cool if they compensated us for the puts that should have printed earlier this year. You know which one got me the most? Remember when June ripped? And Tom Lee was like, oh, the PCE print tomorrow is going to be like 3.0. Revised up. Yep. Revised up to 3.2, where it should have been. In Feb, when we got that second upside leg before SLD, 5.54, revised up 5.84. June's the one I was talking about. Fuckers, yeah. That means the market's been even more irrational? No, there's nothing irrational about the upside in our market. There really isn't. Investors aren't being irrational. Like, you can look where they're putting their money, right? And they're putting all their money into money market funds. September hit a new yearly high for money market inflows. They're now at like $6 trillion. They've done nothing but go up since last October. The average like retail investor, boomer, what have you, has been pretty guarded, right? And you know that constant outflow of capital into money markets really just goes to show you how concentrated the positioning is in SPX that has driven our upside. And it has been methodical and planned. It's not a mistake, it's not irrationality. It's absolutely what one or two very large entities wanted. And only when everything has turned against them has it become hard for them to pump the market. And even now, they can still pump it pretty fucking hard, which we found out Friday morning, right? Like as as long as I've been in the market, I've never seen 50,000 like zero DTE contracts stair stepped up every 20 minutes for like 3 hours until the market was up 250 BPS. This is not retail, right? This is not multiple parties. They're like, oh, I can't wait to buy the next $5 strike. No. While selling, 150,000 puts per level. In the exact VIX auction window, right? Like if this was multiple entities, like short puts would be being sold all over the chain, right? They'd be being sold 10 days out, they'd be being sold 30 days out. Nope, all the puts are sold on the same dates at the same strikes. All of the zero DTE calls are bought at the same time. Like it's not retail, it's not irrational. It's structured and well planned. I'm a bull and I feel like the puts should be compensated. It's kind of bullshit, yeah. But I'm wondering how the news of those revisions is going to hit, as we move. And since we have a 45-day extension, we're now going to definitely get CPI and PPI data going into the November Fed meeting, and both of those are expected to pick up significantly. Oil prices have been very high through September. Sorry if you said this already. Do you think the market reacts to the adjustments? I mean, they'll have to react to the forward predictions because of those adjustments, right? So they're going to have to assume that the Fed was, until the Fed releases another dot plot, they're going to have to assume that, the Fed's dot plot of, lower into 24, and then lower again into 25, right? 24, 23, 25, is probably a little bit incorrect, and they'll have to adjust that. Because this means Supercore has been decently higher than the material data that the Fed has been using, right? And for longer with less periods of improvement. So yeah, there should be some. The bond market should price in some, or the swaps market, or both, should price in some expectation that the dot plot is a little more hawkish than the prior Fed meeting had assumed. Not that they will, but they should. They revise it whenever they want. Yeah, pretty much. It's pretty common. Dork's talked about this before, and he's not wrong. It's pretty common during periods of economic stress for GDP and broad economic, like labor and inflation data, to be a little suppressed, right? And then it's usually revised in hindsight. Specifically labor. Labor's always, like, the revisions to labor can be pretty shocking. How safe are treasuries really? Is it ever possible that gold could be safer than treasuries? Sure, but you're also, I mean, then you're betting on like economic collapse of the like the global standard fiat currency, which is absurd. We're very far from anything like that happening. And the entire world is incentivized to keep that from happening. Nobody benefits from it, even Russia. Gold is good when currency valuations drop, right? Banks still use gold as a currency hedge. Um, and if banks go into the gold market because currencies are devaluing, and this is something that we would experience during a deflationary period, not a disinflationary period, but a deflationary period, and gold were to rise, banks would be using that as a hedge against their currency holdings. But that's it, right? Like that's the extent of gold's financial usefulness. Other than that, it's an overpriced commodity that's infinitely recyclable. It being rational is actually more terrifying. I don't know. I kind of like it. Makes me feel less crazy. Managed SPX puts 3045 DTE. How do you decide when to close a call, hedge, and take profits reposition? A certain percent gain or a certain number of DTE? So if you have a call hedge on longer dated puts, you really don't want to cut it until the market's moving back towards your puts, right? It's not about achieving peak profitability on your hedge. It's about keeping your hedge in place to protect your larger put position. Obviously, some profits on it are nice because you can use that to average down your puts or build a new hedge, and so you can sell the top, but you have to be prepared to re-hedge and reposition immediately. I don't think the number of DTEs necessarily relevant there. Obviously, in the 30 to 45 window, your theta decay is relatively the same, so you're not really concerned. It's when you start going under 30 that theta decay becomes a more pronounced problem for your position. And at that point, yeah, you probably need to do something like either sell puts against your long dated put position in order to slow down the rate of decay, or you need to reposition your put position, and that depends how far into your hedge you moved, right? I mean, if you have like, say you have 50 puts and you have 20 calls, and you move, these like $30, and there's like a $30 spread here, and you move $30 into the money on your calls and you close your calls out, right? You're probably best at this point closing your puts out because your calls have printed more than the value of your initial capital cost of your puts, and then repositioning your puts and placing a new hedge. Now, if it moves like $5, you're probably better off just averaging your puts, right? So kind of think of like how wrong you are. Should probably tell you if you need to reposition. BAC or GS, they're both big enough. They all are. It's hard to say who it is. BAC's had the most equity gains this year, so they've definitely benefited most from the dispersion of vol into equities. That doesn't necessarily mean they're doing it, but it adds some weight to them maybe being the ones that are. I should say right up front that my expectation tomorrow is that we could see a little bit of upside. There was more of that short dated call buying, right, that we saw at the beginning of this week. on the end of the day Friday. Right, and that led to like a little bit of upside that ultimately failed, but we may get a little bit of upside here that'll fail, right? I don't think that's out of the question. Dealer delta is a little more positive. Dealer gamma is a little more positive. So there's some call positioning that came in here, and then obviously that could get hit with any kind of sentiment surrounding the extension of the government timeline. So, but we still have a shitload of resistance on the upside move. The chain is still bearish. So even if we do get like a little pump, it's just another it's probably just another put re-entry opportunity unless we start moving substantially above 43.50. Well, we no, I don't know. We haven't come anywhere fucking close to that gap yet. But we could. We could fill it. It's not completely out of the question. The JPM collar rolled down. Now it with sold calls now at 4,500. Long puts at 40.50. And the sold puts at 34.10, I believe. That's gonna have a bit of a bearish effect across the chain as far as dealer exposure goes. But given that the strikes are still so far from the money, probably not a lot of immediate effect on the price. What was that comment from Ueda about that he's going to talk about Japanese finances? Well, they're getting some. I know we get some notes from the Japan meeting tonight. I'm not sure what time those are coming. BOJ summary of opinions at 7:50 p.m. And maybe that'll give us a little bit more insight into the individual Bank of Japan presidents and how they feel about the current situation. But again, I'll say this for like the 90th time, because you really love to ask me about obscure Japanese central bank financial news. I don't think the Bank of Japan is going to move until the Ministry of Finance has used up the reserves they have held for stabilizing their currency value. Now, depending on the pressure at the time, and the US's inflation print and JPOW potentially raising rates again, the Ministry of Finance may run out of capital in reserves very quickly. If they do, then there's a slim chance that we could see the Bank of Japan move forward with a more restrictive monetary policy before the end of this year. Better to have physical gold and not paper gold. Yeah, that way you can club people with it in the wasteland. Or gold plate your Colt 1911. Although you don't need a lot of gold for that. Well, think about the short puts being de-risked a lot the past few weeks and having 30 to 90 DTE. Would be a decent amount of theta to catch the tail end of that, or better to just be patient? What would be to catch the end of them de-risking? Well, they're de-risking their in the money positioning, right? Like, bulls have been saying for a couple weeks now, like, we don't think we're getting back to 4,400. We're not really sure we're getting back to 43.50. We definitely aren't getting back to 4,500, 44.50, where they've de-risked the entirety of their underwater positioning, right? But that doesn't mean they're not risking on in equivalent levels at 4250 and 4200 and further down the chain, because they are, right. That's how they continue to short VIX. So they're not confident in a lot of continued upside, but they're very confident in continuing to try to bleed out their short put position over time, which means that put sellers are betting on a volatile low range, right, between like 4350 and right now 4200, and they're saying that most likely for the next like 90 days, or well, at least 30 days, we're gonna be trading somewhere in this range, right? Now they were wrong about that when we were trading at 4600. Otherwise, they would have de-risked back then, and this would be the if they fail 4200 in the near future, this would be the third time that they've been wrong about the market's desired levels in the last 3 months. Any commodities you're interested in other than energy right now? Besides nat gas and oil, I have some like fertilizer exposure or potash. I have some exposure to coal. Well, I guess coal is energy. Metallurgic coal maybe isn't. Anyway, I'll just classify that under energy. Copper. I'm not interested in steel right now. I might be interested in aluminum, but I still haven't decided. I have a small position in silver and a small position in gold, but that's more for currency than it is anything else. A little bit interested in food, but not yet. Soon, but not yet. The government shutdown doesn't really matter since they all get back pay. Well, if it goes on for a long time, it does. But yeah, this is not a debt ceiling shutdown, and that seems to be the thing that people are most confused about. This is an appropriations shutdown, which is not the same. This isn't like something that's going to lead to like credit downgrades or anything like that. Like it can lead to a small reduction in GDP if it were to extend out for multiple months. Yeah, we're past the JPM collar roll. I feel like the way things are set up, we may open with the market down 2%. But the most I can see it going to is 4350, 4380. But it ultimately looks like bears are targeting 3700, 3600. That would be a probably a more moderate valuation for equities right now. I would say that if equities were to get an agreement with the bond market, that we should be trading at like a PE of like 16 to 18, which is roughly 36 to 3800. How bad is it that I'm a perma bull? I mean, you'll get returns and then you'll lose them all, right? I mean, I don't think we live in a day and age where being a perma bull still works. Um, I think you'll see over the next 10 years that market crashes are going to become far more common, and those return to equilibriums um, are going to happen more and more frequently, and the value of buy and hold is going to diminish. And so I think that, like, money invested in the S&P right now, instead of enjoying the, you know, 8 to 13% year over year returns of the prior century, are likely to experience greater degrees of fluctuation. And your actual improvement over time may not be that great. So, I mean, doing the boomer thing and buying mutual funds and parking all your money in ETFs and just waiting for shit to grow, that might be running its course. I think there's pretty compelling evidence that over the next 20 years we're gonna largely exist in a financial market where that's not true. If we want America to survive, and continue to grow, that won't be able to be sustained unless we go through a period of very, very, very bad downside or war, big war. That could fix it too. Where are most of the rolled sold puts dated at? Between October 20th and November, like, was it 17th or something? There's some sold puts that are even further out than that, but I think right now the majority of them are between they're currently being sold between, like, as of Friday, October 23rd and October 31st. Although there are some sold puts for the 17th as well. Most of the ones for November 17th are long, however. Is T still worth adding more at this price? Or could we see a drop of the upcoming divvy payment? Yeah, the dividend could lead to a drop in share price. It usually gets priced in. It's also not a shutdown. At least the 40, yeah, I know the 45-day extension was passed yesterday and approved by the Senate today, right? Way behind. We talked a lot about dividend ports. Mind giving us a handful of dividend stocks you hold? Yields to aim for. If not, I understand. I mean, I generally don't choose dividend stocks based on their yield. Um, if I'm gonna buy and hold something, I usually buy and hold it because I think the company is good, and if it has a yield, that's nice. But I prefer to sell covered calls anyway. So generally, my portfolio is more exposed to growth than it is right now. But if you go in, like, the Dillionaire Discord, I have like a spreadsheet up of all my current, like, dividend positions. It's not all my long term holdings, but I think it's everything that I have that has a dividend. You following DK Butterfly? RC is a 10% owner. No. Is that like the book thing? Are BTU CSV good if it stays around mid 20s? Or wait to see if it goes below 20 again? I'd probably wait and see if the price drops. So if China doesn't make a move this year and provide any stimulus, the price of BTU will go back down again. BTU could move really fast if China's gonna start investing a lot into growth, then yeah, BTU could go up very, very quickly. I don't know what time frame would be because it's based on a political decision that hasn't been made. What's up, Varex? New fertilizer mine popping off in England? I have to look up the name. Okay. So they're expecting VIX to rocket because crack spreads dropped. Possibly. It can drive a lot of like volatility in the markets. It also creates a lot of like bond demand, right? Which drives up volatility. GME and Fubo? Yeah, we can take a look. GME kind after like Cohen's CEO announcement, we got a little bit of liquidity realization in the pre-market. Although it's been starting to turn around since then. It may not. If this continues to contract, we may start to see the beginnings of a GME run into what, October OPEX, and they may be a little earlier than October OPEX because there's a bunch of ETF FTDs. I think during the SLD week. But yeah, I mean XRT will have to come off reg show at some point. They reg showed XRT back here. Liquidity came flooding back. XRT got shorted into the dirt. So yeah, I would say I'm probably, if I were to take a position on this, it would probably be like in the first half of the SLD week. And then I still wouldn't get a lot of exposure. The options chain still isn't very exciting yet. Although the movie coming out and stuff might bring back a little fervor. I doubt it'll bring back a lot. Fubo's been kind of weird. It may be failing now, but it may just fail back to the trend again. Give me 1 second here. I don't know why that's not turned on. Um, yeah, Fubo liquidity is still pretty tight. Um, that might kind of be in the same position as GME. Something in the middle to the end of this month. Actually, I guess it could be sooner. I know Fubo had a big, like IWM has a big fat pile of FTDs at some point. Was that ETF? 10-9. So not this week, but next Monday. There's like 3.75 million fails in one day. So yeah, Fubo may still run a little bit. What's Gamma Max on GME? I don't think it's very good right now. At least it hasn't been going up substantially, which would be a sign that we're seeing some out of the money call buying. Yeah, 21.31 right now. So it's super shitty. CNS will be busy. Good. Yeah. Is there a time limit for how long they can keep it on Reg Show? No. They usually want it off of Reg Show before the next rebalance, though. Have you considered that top is the one true stonk? No. No, I haven't. I haven't seen the Dumb Money movie, so no, I don't really have any thoughts on it. I also have no intention of seeing it. If it's ever on like Netflix, I might watch it. Beautiful chart. Yeah, it's not really getting any of the fun dead cat bounces one would want after such a hard squeeze, but Dumb Money's fine. Not amazing. Not an anti-retail hit piece. That's cool. How should gamma charts be interpreted? Sometimes all of a sudden call gamma that comes and pumps the market. Other times, like Friday, they fail. That's because gamma charts just tell you a little bit about positioning on the chain without telling you much about the direction of that positioning. They're not by themselves, they're really not very useful. I know that the Discord has an entire thread dedicated to people watching them all day, but mostly they're just bias confirming. The market likes to move to big piles of gamma because, well, the market maker likes to hedge off their risk. But aside from that, they're not extremely telling. And sometimes you can have big piles of gamma that the market doesn't go anywhere near all day, and that can be a factor of, where the market makers need to hedge off risk. Just because people are buying tons of out of the money positions doesn't mean the market maker needs to pack on a ton of hedge, right, in order to manage those positions. Like sometimes those positions are just bad. And we saw a shitload of call interest out of the money Friday morning, basically just go nowhere, right? Like the 43.40, 50, 60, none of it ever went in the money. And those were some of the largest piles on the chain going into market open. There's many other effects, and gamma charts are just a small window into dealer positioning. When you post charts in the AM, I ignore them because I don't get it. That's fair. Do you think this past Wednesday could be a local low in an up-down wave downtrend? And we may go up for the next 4 to 6 weeks before going back down. Ew. Have you just been reading way too much Dow theory? I don't think that the current trend has a lot of impact on the direction of the market. I don't think technical analysis is all that effective or correct. So, and even from the technical front, no, not necessarily. Right? This would have been, you know, locally. We did test the upside of our downtrend and we failed it on Friday. Right? We actually broke out and failed. And then if you go out to the daily, I think it's a pretty broad, like big assumption to think that we'd move back to like 44.50 over the next couple weeks. I don't think 4,400 could be completely out of the question. Maybe in like the pre-SLD period. But this is expanding downward. Right? So this isn't parallel. Oh, I hate technical analysis questions. Why, CML? But until we get positioning that could facilitate some kind of upside move, like there is no upside. There's nothing there to drive it, right? So it kind of doesn't matter what the technical analysis looks like. People still need to buy calls for it to go up. Can you do Tesla? I'm looking for upside resistance on bullish delivery news. Was the delivery news bullish? Is it out yet? They come out tomorrow? Probably 260 locally. I mean, we're right in the middle of like two major resistances here. No, but somebody needs to get. It's not that there's no upside potential on the market, right? It's that there's no positioning on the upside for like an extended rally. How much do you factor seasonality into your trading strat? I mean, I pay attention to it, but seasonality is different every year. I picked up $5 Siri jam calls when I saw the borrow rate rising. Yeah, it might run. That'd be cool. We're getting close to the T69 from the last run, I think. I'm about to head to a winery's vintage release party. Want me to pick you up something nice? No, I'm alright, thanks. Yeah, so Tesla's upside and downside resistances are well, PTs would be like 61 and 35. Right now we're trading very close to like 42.50 or 250 rather. And this is a pretty important level. So I think it could, I mean, depending on the delivery numbers last week, it could go either way. But it might be weighted a little more bearishly since so many zero DTE calls closed on Friday. Charm on Tesla Friday was insane. And so now all those options are gone, right? And the dealer will shed that hedge. So there'll be pressure to the downside, but it could still move up on good news. With NAV still higher than market value, does this suggest that FSRF might turn around to go for another move up soon? Yeah, it could. Yeah, as long as NAV is positive, they're going to keep buying uranium at spot, right? And that's reflexive with the value of the fund. So if they're going to, like, that's the cool thing about SRF is the more they buy, the more the value of uranium goes up, which means they buy more. What do you consider to be high and low gamma per series and per strike? Oh, that depends because the weighting on them can be drastically different, and most of the charts that you look at for gamma are scaled, but yeah, that's really more of an effect of how much open interest there is at any given time than it is anything to do with like the high. Like sometimes you could have very low amounts of gamma on the chain, but you still have levels that are important. You got very high amounts of gamma on the chain, and still also have those same important levels. So it's the amount of gamma is kind of just a product of the amount of interest, right? And in a low liquidity environment where you'd have fairly low gamma per strike, like realized volatility is way higher. And in a highly liquid environment where you have more gamma per strike, implied volatility is higher. Are CC or CSP on SRF worth it? They don't have options, as far as I know. It's like an OTC. Dips. Well, Dork's not here, so I'll time you out, Dwayne. Yeah, this week also just closed down, right? So that's actually kind of interesting. We were discussing like the weekly and monthly continuation effect, and this is kind of a technical indicator too, but um I wonder if that's kind of the end of it, but we still closed lower than we opened by what? 43.10 and closed at 42.88. It kind of still looks like it's continuing. So the end of August and now end of September have both closed lower on the monthly, which is generally like your first indication of beginning a bear market. I would say that we are in fact oversold though. But we could keep selling off like into a hmm. We'll see. We kind of bounced off the 200 MA, or we came moderately close to bouncing off of it, like $50. Maybe we test the 200 MA this week, and then we'll see. Then there might be a period of upside. But I think we're still going to be pretty data dependent. If I use lagging indicators but trade backwards, will that help me? I'm driving. Where's the 200 MA on the daily? Um, Hold on. Let me try to find it. Okay, so it's those two lines. Uh 4130? Oh no, sorry. That was the wrong line. 4200. No problem. Yeah, and correlation, the trend in correlation still picking up to the upside, so you know, and we saw a lot of vol return on Friday. So I don't think anything near term is super bullish. There's so much like negative positioning on the chain to the upside that they have to grind through before they can even stabilize a bullish position. Um, that I think we're still in a better spot to continue moving down than we are to attempt moving up. And we're not at a point where calls are cheap, right? Calls are still very, very expensive. So it's not like last October where, we were, calls were practically free. CDRE, they make gear for police and such. Okay. Are police departments really becoming better funded? If they're not, they might be. I could see that, yeah. Hmm. They have a decent slow rate of growth. If we really hit a recession and unemployment really rises, we'll probably start to see more municipal funding of police departments, and I guess they could be a beneficiary of that. It's like the same reason people, kind of the same idea for why people go long, like private prisons into a recession, right? Like Burry's play. Um, is that when unemployment goes up, and you have inflation, you tend to have higher crime rates, like we saw in like American urban and like urban areas in the like late 70s through mid 80s. So yeah, it could continue to grow. I don't think they should be paying a dividend, but I don't know if that's really all that reflective of the management's competence. When do you plan on rolling your SPX October puts listed in Pickles picks? Hmm. That's a good question. Let me look at my positions. Because I know I moved some shit around this week. Let's see what I have left. So I already took profit on October. The rest of the 4400 and 4350 Ps. Both of those got stopped out on Wednesday, as did my October 31 275s. I actually have 4320s for October 20th that I opened on Friday morning. But then I think that's all I have for October left. Oh, you know what? I still have my 4300 4150 bear put spreads. Those I haven't closed yet. And then I have like my straddle and stuff, but that'll be probably closed tomorrow, right? I have some out of the money spreads that I sold for tomorrow's expiration. Bear call, no bull put spreads for tomorrow. Yeah, everything else is all the other October shit's closed. I'd like, I mean, they were already in the money at the beginning of this week. So I don't think I need to roll any of it. The November 17 250s, I bought a few more. November 4200s, I bought a few more when we retested the upside Friday morning, and VIX was low. Just because I got a little bit of an opportunity to average them down off my call hedge. I have some 4300s for November 17th now. But that's a whole new position that wasn't rolled off of the old one. So yeah, not much left for October. It could be smart. It'll be smart to play the early part of this week safely. PMI is expected to be doing better tomorrow. I think if that misses, that'll probably set off a cascade of more selling into this week. And then we'd be really looking towards like uh maybe like the 11th for things to start turning around again. Do puts cost same like shares? Sometimes, Durek. Oh, wait, are you in the thingy? What's up, man? I can just talk to you.
How you doing, bud?
Yep. There we go. I think I have your volume. Uh,
Nice.
what's up, dude?
How are you?
Oh, I'm hanging in there. Little tired. I had like a big fucking breakfast, and
Oh, nice.
now I just want to go back to bed.
What was the breakfast?
It was corn like corned beef hash.
Oh, fuck yeah.
Yeah, it was good. It was like house made, like they make their own corned beef.
Okay, that's so good, dude. Nice.
And then had some poached eggs and rye seeded rye toast.
Damn, dude.
But it was salty as fuck. So I'm just like, and I was not well hydrated after last night anyway. So I'm like,
Oh yeah, so you're like an actual pickle right now.
yeah, like a little hungover, a little dehydrated.
I got the electrolytes. And all I need to do is dissolve them in water.
Yeah, I'm gonna soak myself in a freshwater bath for the next 3 hours, and then just let osmosis run its course.
Well, that sounds nice. Unfortunately, Jay Fresh isn't gonna make it today, I don't think, because he took the Scrabble game from the HOA's game collection, and they raided his house for it.
Yeah,
So
yeah, I
now he
heard.
has to answer the Supreme Council.
It was actually on the local news, um, in his area, which I monitor carefully.
Well, I mean, yeah, well, there's usually nothing going on besides like, lost cats and stuff. So
Yeah, yeah. I
yeah,
heard
no,
I
no
heard that
surprise.
he'd hunkered down against law enforcement and was affecting some sort of
I mean, yeah,
standoff.
he. I'm pretty sure he had a lighter to the box, and everyone was trying to, they had the negotiator in there, but I don't know. I think at this point, I think he's actually surrendered to the HOA, and now they're in discussions, to figure out how to deal with this. But anyways, he's going to be a little busy.
How's that going to affect his position as head of the HOA moving forward?
I don't think it'll actually affect it, ironically enough. I think that in the end, they're going to understand, his love of the game Scrabble
Okay.
and his genius use of the letter J in his Scrabble, conquest.
Did he try to use his own name, Jay Fresh, as the winning combination? Because I could understand that being difficult to find in a standardized dictionary.
He probably did,
Fucking
but
cheater.
I know, right? Yeah, I mean, slang doesn't work. I'm sure he busted out his Discord profile and
Yeah,
was like,
yeah.
look at how many people respond to me.
You know what he did? He busted out his Reddit DD and he's like, it's been published. It's a real word.
They're like, that says Dr. Gingerballs, though.
it's
There's no J's in Dr. Gingerballs.
true.
Anyway, how's the stream going? People asking calls or puts.
People are being excessively bullish because they have bearish positions. The usual for the weekend. Everyone thinks that the market's going to rip to 4,500 because the government shutdown ended. They're worried that their concerns about the market ripping to 4,500 because the government shutdown has been ended aren't being heard. I hear you. I understand your concern. I don't know how you
So,
ended up more bullish than the Bulls. Like, you can go look at Wall Street bets, and the Bulls are like, man, 4,350 this week would be sick. And Bears are like, we're going to 4,600, no cap.
well, dude, I guess the irony is that everybody thinks that the risk of a government shutdown was being priced in last week.
No one gives a shit. It's an appropriation shutdown.
Yeah, it is. I mean, unless like we actually get a government shutdown, and two, if it goes longer than 3 weeks, then we have a problem, and it starts getting priced in within like a week and a half, 2 weeks. But like heading into it, we
No.
literally just got the news that something might change in a little bit of time, and then we got the news that actually, psych, nothing's really changing. Like
Yeah.
no one's gonna fuck.
But I don't think like if they were pricing in a shutdown, a day delay would not change their pricing of a shutdown in, right? Like if you're gonna buy into efficient market hypothesis and assume that all events are priced in before they occur, then you have to assume that the government not shutting down was also priced in. So get fucked.
Everything's already priced in.
I
No
hate
event
I
have an
hate
impact on
Keynesian economics, and I hate the efficient market hypothesis more than
sure.
anything, Dork.
Everything is priced in already. Okay, if that's the
Everything
case,
priced
the market
in
never
all
changes
the
price.
time.
Nothing should ever change. But anyways, I got some interesting data, just a table that I was looking at this morning, um,
Sure.
and I was
Which
just kind of
one?
thinking about it.
Wait,
It's just in the fuck. I put it in the wrong.
you put it
Hold
in
on,
the
I'll put it.
right? I can find it. I found it. No, I didn't find it.
I spammed it into the other chat, the
Oh, okay. I'll open
one we
it.
all fuck around in.
Ooh,
Um,
this one's
yeah,
fun.
it's just an interesting chart. You know, you got well, one of them is a year over year rate of change that's on the deposits. The other one's just the percent change, like quarterly percent change. So you got
Yeah.
quarterly percent change of the delinquency rate on credit cards, and then you got the year on year percent change of the deposits at all commercial banks. I guess I could switch that over to quarterly.
So you're
But
trying to prove that people are running out of money.
I don't know if I'm necessarily trying to prove it, but it's just an interesting data point. So credit card delinquencies are reported quarterly, and we have had how many data prints of increasing credit card delinquencies at this point? What is it like? 1, 2, 3, 4, 5, 6, 7, 7 quarters a year, almost 2 years of increasing delinquency rates on credit cards. And if the actual value of the delinquency rate is also back to like historical norms at this point, like right back at them.
Mm-hmm.
So, you know, I find it very interesting. At least, I mean, like, I guess it's not really like historical norms because if you go back to like the 90s, we're looking at like what is it, like a 4% delinquency rate on average, which right now we're right back to almost three, which between 2 and 2.5 is the norm for, post GFC delinquency rates. So I found it interesting, because yeah, it's a decent data point that kind of shows that there's a K-shaped recovery happening in the economy. That's the thing that there's some economists were talking about, but it kind of got forgotten about because it's kind of a boring sort of hypothesis. But it kind of describes this duality of recovery where we see people with assets, doing okay, people with decent incomes doing fine. They're people who are making plenty of money are seeing their incomes go up. People who aren't making enough money are seeing their incomes go up more slowly. And in aggregate, what you see is a decline in deposits and an increase in credit card usage for everyday goods like food and energy. Um, so I just found it interesting, and I just wanted to throw that out there. And
What
you know,
does this make you feel?
card spending, is that like debit and credit?
Yep. Real time.
I see. 4-week moving average. Well, this kind of tells you that people are changing their spending habits. Like they're actually changing their spending habits. What I showed was people changing their financing habits, and what you're showing me is people changing their spending habits. That's interesting, right? And
Mm.
this kind of falls in line with what was happening with PCE, right? Like a core PCE was like
Wrong.
so PCE was core well, yeah, so PCE was up, core PCE was pretty flat, right?
Yeah.
And what that tells you is that consumers they're not just like they don't just have the cushion to absorb increasing energy costs. They're actually also shifting their spending habits in response to energy costs. which tells you that the consumer does not have much more room to the downside before they're in some difficult spots where they actually will have to cut back on discretionary spending to an appreciable degree, and we'll see a larger portion of the of publicly traded companies see reduced earnings, right, reduced revenues, and I don't know if necessarily their margins are going to be hurt, but their cash flows are definitely going to probably start slumping in the next couple quarters if energy costs stay this high. So that's interesting.
I also mentioned Friday that we have bill issuance through October and November is expected to be at 433 billion, right? And then total supply has increased 1.6 trillion year to date. So we're going to hit 2 trillion net new bill supply in the 2023 calendar year.
What's on RRP at this point? Have they been
It's just absolutely fucking wrecked. Yeah, all the MMFs. I'll show you something for that. But yeah.
Oh yeah.
Yeah. I mean, it's down almost $1 trillion from when Superstock was freaking out about it back in January.
That's an interesting data point. If we were going to talk about any discussions of market liquidity and things like that, you have to talk about RRP.
Yeah.
And clearly what's happening is kind of the Fed's intended effect of the RRP, right? When they go to sell a bunch of treasuries at these interest rates, there's this sort of buffer in place to absorb a lot of that selling, right? So it's like this is kind of like your buyer of last resort in a way. So it's from one perspective, it's good to see it having its intended effect, but what remains to be seen is if the Treasury needs to issue more than on RRP can absorb.
Well, this is the cumulative bill supply projection through 2024. Right, so we're projected to see a fairly sharp increase in bill supply through Jan, and then from like Feb through April, we're gonna see another, probably the peak of bill supply. Going in,
dude,
going
that's gonna drain RRP right there.
Yeah, I mean this should start draining it right now.
Oh, we are, yeah. But if that forward projection is held, we'll probably pretty much empty out RRP by looks like April.
And this is the bill and coupon issuance estimate by month, like the full breakdown.
Yeah, on RRP peaked at what 2.4 trillion, just about. So
yeah,
2.5,
2.54, I think.
But yeah, on that spike, yeah, we got a pretty big move.
And then money market managers are going ape shit on the auctions because they have so much inflow.
Yeah.
And the yields are finally getting into a range where they expect continued cheapening, right? And so they're redirecting tons of capital from on RRP into new issuance.
Interesting stuff, man. That's it sounds like yields are going to continue up, but I mean with the amount of interest we're starting to see in treasuries, I mean it could be a little muted.
Yeah, I agree.
So like we may see the 5-year hit 5% over the next, I want to say 6 months.
Yeah,
but that's about what I expect. But
better question is when 30-year 5%.
Jesus.
We're close.
Well, I mean, yeah, it's one of those things where the 30-year somehow has remained uninverted from the 5 and the 10. And I don't know how they managed to keep pulling that shit off, but I mean, all that points to though is that we're just going to see the bear steepener, I'm sorry, Jay Fresh, for saying bear steepener, but we think that's what we're really looking at, like just in action, right? Because we've been seeing the long end, even on Friday when the long end like tanked, it fully recovered by the end of the day.
Can I ask a question for Popcorn Trader before he asks it in chat? Does
Sure.
bear steepener mean that a bear is hibernated on a hilly surface? Like on the downside slope of a hill?
A
And
bear
then
steepener is when a bear is running on a hill and the hill gets steeper, so the bear starts going faster.
that makes sense. Okay, there you go, Popcorn Trader.
That's the classical definition from I believe that's in what's his name, Graham's book, The Intelligent Investor. I think they go over it in like chapter 7.
Yeah, well, sure.
So yeah, we're I think we're kind of seeing it. I mean, the long end just keeps recovering. Interest in those treasuries is like, it's weird because you'd think people would want to risk off, but like long-term risk appetite is not quite, low enough for people to think to themselves, I need to protect myself for 30 years with a reinvesting T-bill.
Yeah.
But I mean, if we get there, right,
I mean,
that's
I want to buy
bad.
the 30-year at 5% so I can sell them to Jamie Dimon later on
That'd be kind of nice.
because he'll be buying them all, right?
Yeah, he'll want them at 5%, that's for sure. I mean, everybody will. I mean, 5% for 30 years risk free is pretty badass.
I thought the bear steepener was a hot tub for people speculating on the market downside. Could be. That's bear.
It's yeah.
That's bear tea. That's different. That's what Carl's missing.
So another thing interesting that happened over the last week. Uh, so credit spreads between triple B and triple A went down and then went back up a little bit.
Mm.
We haven't seen those. We haven't seen the spread drop below 1% since Jan of this year. So um, that's interesting. I mean, we pretty much recovered from the bank failures, so that's it's not like we're doing anything crazy on the credit spread side, but we haven't really we haven't gotten back to the lows of Feb, and we're just kind of trading around a 1% spread on triple B to triple A. So it's like 6.3 on triple B to 5.3 on triple A, just about. Um, so that's interesting. Triple A is starting to be more reasonably priced, but I wouldn't say necessarily that the risk of decreased interest in financing for large companies has been priced in yet. So that's going to be interesting to watch. Triple B, I'm expecting it to go up a lot throughout the next 3 to 6 months because we have that big wave of refinancing happening over the next little bit here. It's actually kind of just
Yeah,
starting. So
that's
that's
also
going to be
coming.
watch.
What's interesting about that is it's also coming at a time when new issuance is expected to creep up like another half a trillion.
Yeah, exactly. Yeah, it's funny. Yeah, we got the Treasury selling their tea bags, and at the same time, we're going to have a bunch of corporations trying to sell their bags, right? Their debt bags. So
Well, they're gonna have to
that's
raise the. I mean, they're corporate like AAA is gonna go up. Like the yields on
yeah.
it are gonna have to go up.
On all of them, they're going to have to go up, and it's going to be interesting to see how that term structure adjusts, right, through over time, right? Is high yield going to just rocket to like 19%, or is triple B going to reach like 7%? Like it's going to be very interesting to see what happens when it's time to put money on the table in that market.
Yeah. Well, AAA is feeling really good about itself because of the downgrades, right?
Yeah, AAA is, well, I mean, it's also AAA, which includes Mag 7, which means,
Yeah.
that alone in aggregate means that AAA's risk profile is heavily suppressed. Um, and a lot of super big companies are going to like do okay, and that's why paying attention to the spread is more important because if triple B, right, which is still pretty good, if triple B, the spread between triple A and triple B goes up a lot, that tells you that risk appetite is concentrating right into just the best of the best, and everything below it people are less interested in. So that's going to be very interesting because it'll tell you sort of the outlook that the bond market has in the private sector. So I'm really going to be watching that over the next few months and just kind of paying attention to see what happens, especially heading into like end of Q4.
We're
So
picking we're
that's
picking up
interesting.
a lot of volatility. Also, we should talk about this. We're picking up a lot of volatility as well as more and more purchasers are incentivized to go long bonds. And they're picking up volatility hedging and all of the things that we're talking about, like corporate yields rising and stuff like this. This is all gonna mean more hedging on VIX, and over time will probably lead to us entering a period of much higher market volatility like we experienced through 2021 and 2022, after this brief lull in the uh, under VIX's historic vol. I think we're moving out of that.
Oh yeah, for sure. I mean, in the way that the bond vol convexity hedge, like it's a dynamic hedge, and when you see it roll in, that means that the premium on rolling your VIX convexity hedge is worth it. Especially if there's like a negative roll yield, like it's so worth it to roll your VIX hedge. And once people get that negative roll yield, it's going to be there. You're going to see VIX not only pick up volatility. You're going to see it just the baseline VIX level just is just going to go up, and that's going to have a drag on any sort of
And
upside movement.
we can kind of see that that's been happening over the last few weeks here now. Several weeks, I guess, almost a month total. We've had a pretty consistent climb in VIX to the contract, and like correlation between VIX spot and its contracted front. We've moved into backwardation a few times. Um, I think we were moderately close to it at one point on Friday and managed to close the week. Yeah, we closed the week under, just under.
Yeah, I mean, Friday was a really interesting day. It just seemed like there was just a lot of selling happening, and it was kind of fucking shit up. I mean, throughout the day, you'd see the market try to like get back to like just some sort of good even positioning, but it could never really get a foothold. The pressure was just too high. So I think so. And plus with the puts rolling in at the end of the day, it seems like someone caught wind that someone else is selling. I think, and
Yeah.
it is just very interesting, and real opinions are starting to form in the market.
And if you look out on the 4 week, we have 4 consecutive weeks of increased correlation now, between VIX and VIX futures.
Yeah, we're re-entering a like an actual correlation, right? Like
Yeah.
it's exiting weak and getting back into strong, which is interesting to say the least.
I don't know if we have
Uh,
enough yet to confirm it, but we're getting there. I mean, this is a pretty
well,
dramatic increase, right? This is almost 2% a week.
if you could go back to that vol bond curve comparison,
Yep.
we can talk about how there's sort of like we could talk about like sort of how the tail effect of that is what is causing this correlation to pick up, right?
Yeah.
Because when you look at this, when you look at green and red, right? Can you just zoom in on the front end there on that last little humpy hump,
Yep.
and just kind of let like so we could see granularly what's been happening recently on the daily. Because like I have my blue line, but we can talk about red and green the same way. Yeah.
Yeah.
So So you see the spread between the two, right, is starting to collapse, right? And it's collapsing with VIX to the upside. So really this is sort of why we're seeing that level of correlation increase, is because you're seeing the relative convexity of the VIX term structure and the bond term structure, I guess you call it, just the yield curve, right? We're seeing them sort of start to almost de-invert, right? And when that happens, I think that's when you start to get into the territory of like the negative roll yield on the VIX hedge, and how that, what's happening at that point when you get the negative roll yield on the VIX hedge, you're getting to the point where your hedge is actually mitigating your losses, right? And that's when you get kind of like the rush for the doors on that hedge, because everyone's going to want to be in, and you really lose control of the ability to mitigate the spreads on the SPX options chain as those futures and VIX itself start to get, legitimately hedged by the market maker, and they push their spreads out. And if you try to collapse the spreads, they buy it up and they keep the spread wide.
Yep.
So it's very interesting, and throughout the throughout the week, you would see that spread get down to, I think at one point it got to like 76 basis points, like it got tiny, and
Yeah.
that's a really bad spot. And whenever it did get that close and that tight, you'd see the market bounce, and you'd see VIX get smashed.
Yeah.
And clearly, it's to try to keep that roll hedge from getting advantageous, right, for bond portfolios to really lean into. So they're really, like, anybody who's really like hedging their convexity right now is sort of eating a little bit of shit each time they have to roll. But that's very slowly, I guess you'd say, or quickly. I don't know. It's coming. It's starting to diminish, and it's starting to become more and more worth it for people to hedge like this. And it's really advantageous for bondholders, because you can protect your portfolio from a whole lot of losses by doing that, right? Um, and that's really kind of what's happening. But yeah, and and with the swap chart, you can actually see too. It started going up the moment that the spread started collapsing.
Yeah.
So we know what's happening. People are leveraging into the short VIX products to keep the spread small and to keep that from happening, and they lever in super hard when the spread gets too tight. And
Yeah,
like I've seen it with my kids too.
leverage VIX products picked up like 60 billion in net assets last week.
Yeah, that just tells you that people are starting to move into the hedge more, and which is gonna cause this, right? It's not like one's the tail and one's the dog. They all it's a dance, right? It all sort of moves around each other. If market volatility picks up, interest in those products pick up, and then you get a positive feedback loop. If market volatility drops and things look good, you see the interest drop off. The spread widens, and then the roll yield goes super positive, and people get screwed over when they try to maintain this hedge, so they dump it, and then the market fucking shoots up. But we're seeing a real fight, right, between, I think there is such a large constituency of people who are, short. If you're a short Treasury position, right, then you hedge with the inverse, right? You're the counterparty basically to that vol convexity hedge, because you're hedging the other way. And
Yeah.
so we're seeing a sort of a fight between longs and shorts in the bond market, more so than the equity market. And the short Treasury position, I think, is
Losing.
probably, yeah, well, yeah, I mean, they're losing, but like I feel like they're partially responsible for this crazy, rapid evolution in relative yields between Japanese bonds and American bonds. So it's very interesting and concerning, right? If you're somebody in the forex market and you're watching this, I mean, especially if you have a really large position in the forex market, I mean, this has got to be you've got to be setting off all kinds of alarm bells in your head, right?
Yeah.
So it's very interesting. I don't know if necessarily that means crash tomorrow, but
it really looks like there's some heavily vested interests in keeping the spread between, overnight and short-term bonds and, VIX and in the contract in front from de-inverting, right? When that roll yield becomes positive again, or becomes negative again, that's just going to be, it's going to be crazy. So, something to watch out for, and it could happen, but nothing could happen in the market for a little while. But once it happens, you'll start seeing some weird stuff going on in forex. You'll see some probably like volatility pick up on Dixie and on USD JPY. Something fun to watch, and keep your head on a swivel when that happens. Right? It's not necessarily like I said, it's not like that means the market's like imminently about to crash, but it means that the credit market is starting to readjust, and the availability of short-term debt is going to just go through the floor, through the parking garage, through the sewer, and your ability to just get like an overnight pile of leverage is going to be severely diminished.
So do you want to, I'll let you keep running with this because I'm hungover. Do you want to go into this one now? This is S&P earnings yield by year minus the 10-year U.S. Treasury.
Let's see how far back you gone there. So since mid 2017,
I can go way. I can go way the fuck back.
Well, okay, so I mean, this just tells you that what every asset manager is thinking right now. Any value investor looks at this and they think to themselves, like, why the hell would I invest in equities, right?
I'm just kind of pointing out the disagreement between the equity market and the bond market currently.
That's
and
going to get
what's motivating a lot of the volatility action that we were just talking about.
Yeah, it's only going to get bigger as the maturity wave sort of rolls in over the next 6 months, right? Because
this is our lowest
you're
level
going to see,
since December of 08.
Yeah, you're going to see, because you're going to see earnings, you're going to see margins kind of drop as financing costs go up, right? Your free cash flow is going to suffer.
Yeah.
And so you'll see this continue to drop. So that's yeah, and this just sort of tells you, right, relative value of equities to bonds. It makes no real sense to be in your classic 60-40 right now. It makes more sense to be like 40-60 and be more exposed to bonds because the risk-free return over the short to medium term is just really attractive. Like I don't know. I have a buddy. I have a buddy who I was talking to about this just like it was like a couple weeks ago, and he was talking about selling out of his. He has a bunch of like tech stocks and stuff, and he's up a bunch, and he was like, "Yeah, dude, I'm wanting to sell this all," and I was like, "Well, pay attention, DCA in, DCA out, the usual shit," but like, and then he started talking about being super interested in bonds, and I was like, "Yeah, I mean." It's a great time for bonds. Yields could go up more. And I was talking about like liquid cash versus having everything stuck in like a 2-year, right? Like the big difference between like if yields continue to go up, your liquidity goes down. So it's like not, you kind of want to like really think about that ultra short term, some sort of diversified strategy because you want some cash reserves on the side in case yields do rocket and the market crashes. You want to have something on the side to take advantage of it in the short term, but yeah, and this guy's like he's not like necessarily informed at all. He's really not. Not to say that he's like a dumb person or anything. He's just he's like most people who trade stocks.
Who's this?
It's just one of my friends.
Oh.
Yeah, so he's just like a normal guy, right? But even he is recognizing the risk imbalance in the market, just from a very cursory standpoint, and I think he's definitely not alone. Right, purely
He's
anecdotal.
obviously not. I just told you, money market fund flows reached their highest level all year, which has been a constant exponential increase in September. As of September 15th, and like the last reporting, they're at like six trillion something.
Yeah.
He's not alone. Most investors are scared, and this is why the market didn't hit like prior highs, right? Like that's why SPX didn't run to back to 4,800 or anything, you know, and we ended up failing in August. Is there's just no liquidity up there. You can only pump it so much without other people coming in, and if no one's coming in, you can't
Yeah, who's
support
holding the
those
bag?
prices. Yeah.
I mean, that's the real question is, I mean, like at this point, who is the bag holder? Right? We're still at very elevated prices. I mean, relative to what I think would be a
I mean,
reasonable price. Yes.
Tom Lee's holding some bags.
Oh, of course he is, but like, I mean, you basically just described that a large constituency of the US is not super stoked on equities and probably not super exposed on them. So like, but we're still trading at, 42.88. Like, I
Yeah.
mean,
Yeah.
reasonable price for SPX at this point is right where we got to in March, right? About 3,800, I'd say. Super reasonable to be there through the end of the year.
I think that's an optimistic. Like that's
Yeah,
I mean, so
bullish,
so
right? But
like the Schiller PE right now I think is at 29.5, right? Which is still higher than like where we were on Black Tuesday.
I mean, yeah, and
And
that's I'm saying that our
the mean is like 17. And the
and I
median's
don't
like
think
16.
we're not going to get back there though. I think to some degree we are in a different paradigm with all this, free cash floating around. And if
Yeah, but
on RRP doesn't,
we're starting to see the gears moving towards asset and wealth destruction, right?
but will we have like that extreme of multiple compression over like the short term?
I mean, you have to assume that even if we were to hit a Schiller PE of 20, you're talking a significant decrease in the like that's almost 30% off the current market price, right?
Yeah,
I mean,
that's true.
that's not even the fucking median. That's a high. That's still a high range. That's still, you know, above where we were in the Great Recession, way above.
So, and really kind of, I guess what I'm really kind of banking on is that earnings don't suffer more, right? So, like the thing is if you think about the Schiller PE, like right now our PE is super high because we're at like an average kind of price, but earnings have gone in the toilet, right? So that's why it's so high. But I haven't.
what about the compression from inflation falling off next year? You know, that's an inflation adjusted ratio, right? So like if we're gonna lose, you know, the Fed estimates we're gonna move down to like 3.2 to 2.5% inflation through 2024 or end of 2024, right?
Well, yeah, I'm just like what I'm really kind of getting at is that like the market could crash, PEs could stay high just because of how low earnings are, and
Mm-hmm.
then during the recovery you'll see an earnings recovery, and the market may be going up, but PEs may be going down. Like there's the dynamic between price to earnings is it's not just that price affects PE, affects PE, right? So if E goes up, PE goes down. So like there's going to be some of that happening. We may see PE go as low as 20 to 22 in the event of like a steep market correction, but I doubt we're going to get back to the median until we go down to those levels, and then we see earnings recover, and then we'll see PE somewhere around 17. And it's not necessarily the market's going to keep going down to push to that PE. It's going to go down to a point where the market in aggregate thinks that from here earnings are going to recover, right? And we're going to see like this is a reasonable price where earnings could get to over time. That's what I think, right? But you're right. You're right that as things stand right now, the market should probably be trading at around 3,600 to 3,500, and on the high end. But that's not necessarily like how the asset managers behave, right? They're still trying to forward project an earnings recovery that is unrealistic.
Yeah, yeah, I know.
But they're always going to price in an earnings recovery, right? That's just the eternal bullishness of the market, naturally pushing PE up into an inflated level. But I think you're right. I think we will hit a PE closer to norm over the next year. Um,
with this wave of maturities coming due, the Treasury issuances, we'll see the equities market start to reprice, forward PE to something a little more reasonable in like the 22 range
Yeah,
ish.
I think 22 to 23 is a pretty reasonable range to stay in without a crash. I think
Yeah, exactly.
I think if we do get a crash, then yeah, we're gonna reprice back into a range that's closer to the median or the historical median or mean, which would be like 2800 ish to
Yeah, just
30
about depending on how bad the
2800 to
crash.
3200.
I mean, like a crash is a unique thing. So we could, at that point though, you're not really talking about the market repricing things. You're talking about the market going into like absolute pandemonium, right? So like no one gives a shit about PE during a market crash. They're
Is
just thinking about how
SPX at
to do well.
3000 really fucking pandemonium? I mean, it's only been 2 years since it was there. 2.5.
No, if the market crashed, we're probably going to see below 3,000. We'll
Yeah.
probably
I mean, I
see
think we'll
below
recover to the
2,800.
3,000, 3,200 range. If we get a crash here, I mean, with all the short vol in place, it's gonna squeeze, right?
That's the pandemonium, right?
Yeah.
That's the real problem that's going to happen,
But
and
that's
where
gonna
you'll
last
see.
like the bottom of that's gonna last like a day, right? If that. It
Yeah,
might be a couple hours. I mean, you're not talking about a long period of time hitting like 2,200 or 2,300 levels on SPX. It's not gonna last.
No, yeah,
Reserves are way too high. Like money market funds will immediately start flowing into equities. Like you'll
yeah.
get a bounce.
Not only that, but there's a winner on the other side of the trade, right? And they're going to move in
Yeah.
and eat up what the other people lost, right? And the margin calls and all the craziness. They're gonna be buying it.
Yep.
So yeah, I agree. If we get a literal full on crash, unless it's like just catastrophic, right, where it's not just short vol, it's like everybody's about to die, then we'll see a continued lower price range for a little bit of time, but like it all depends, right? There's no way to tell how bad a market crash is going to get. There's no way to tell who's going to get blown up or who's not.
Yeah,
Who
yeah.
why.
It's completely unpredictable.
Yeah, so I mean, honestly, if the market crashes, like I'm just going to be taking my spare cash and just throwing it in the market blindly and just being like, "Yep, I'm going to pick some stocks that I like and just I don't even give a fuck." And
3,000, you're insane. 3,800 bottom. Man, BlackRock was picking up shit in 2020 at like 2,650. It's really not as far off as you think it is. This isn't your grandfather's market anymore. Our
yeah, no,
crashes moving forward, uh, and will happen more often, and they will be more extreme.
yeah, and this is all due to leveraged volatility products. I mean,
Yeah, well, leverage volatility products, and then also like derivatives market interest in the last 2 years has exploded like 1,500%.
yeah,
Half
it's
of
like
all
we're
this upside is synthetic, right? It's driven by derivatives.
yeah. Like
So
it's yeah.
you've got the collapse of a gearing effect on the market and a return to like actual valuations. I don't think 3,000 is insane. I mean, like I think a crash, the idea that a crash would occur ever should always be considered an insane idea. But when you're talking about how far a crash can go, I mean, think about it this way. The market maker starts actively shorting or longing Vega at the same rate they long Gamma below like 3,800.
Yeah. I
So
mean,
the
and
market
even
actually squeezes like below. If we fell below 3,800, the market would start squeezing down, and it would not stop until everyone was out.
well, think about this too, right? So in August of 2022, we went from a high of 43.25 to a low of 34.91 over the course of what, like a month and a half?
Yep.
Like, so is it really like that's a crazy, insane fucking move. And the
That was
move up
20
before was just straight.
20%. Yeah.
Yeah. Like it's not like that's really not that crazy to think, because and that was a very controlled downside move. I mean, until it wasn't. I mean, near the end it started to get a little crazy, but like that was for the most part a controlled move. So if you want to imagine an uncontrolled move, which I would argue we really haven't had
That
since
was
the
on the
October.
back. Can we talk about for a second that that was on the back of two other 20% drops?
Yeah,
Like
yeah,
like
exactly.
like March to June, when we almost crashed in June, and we did almost crash in June. That was 21%. And then December, end of December 2021 into January was 15%. So we had 15, 20, 20 before we saw any kind of recovery. And you're telling me 30% is crazy?
Yeah, it's really not.
And
And I mean,
financial conditions are way fucking worse now than they were then.
yeah,
That was just
yeah,
fear. That was just people were scared. They were like, fuck, I should take profits on this shit. This doesn't look good.
yeah,
And
and
now
people were just,
everyone has
yeah,
a higher cost basis, right? Because they fucking bought back in December, and not really until June, right? Like the volume through December and Feb was very low. So it wasn't really until the end of April that people got really bullish and started buying hard. And that means that people are like at like 4200 cost basis.
yeah, like the smaller institutions.
They're already scared.
Yeah, you're nervous if you're looking at what's been happening over the last few weeks. Like it's got to make you think, right? And and that's like, I understand, especially after 2020 and 2021, like where Vol just, you know, Vol did a bunch of crazy shit, and the market just recovered practically instantly at every sign of volatility. But, we haven't, like, the moves we saw in 2022 were pretty fucking unprecedented, really. Like when you think about it, we haven't, like, that rapid of movements on, like, over like a, let's say, a monthly candle time scale. It's pretty fucking nuts. Like you don't really see that anywhere besides, like, insane market periods of market volatility, which we only really have a few, right? We have like 2008 through 2011, and then I want to say, like, was it 2015? We saw a little bit of that, but like nothing like this. So we're really seeing, especially like, because this is the first real market volatility we've had since money printer go burr in 2020 and 2021. We're really seeing the effect that free cash getting pumped into derivatives is having on the market, and it's really fucking ramped up realized vol on the long time scale. So like a 30% drop over the course of a month, may seem nuts. Even over the course of a week may seem nuts, but if just one sort of if one cotter pin inside the derivatives machine breaks loose, and that bolt flies out, right? You could see that happen for sure. If just one counterparty goes bust, like a big counterparty, I mean, it's not unreasonable to think that they're going to get margin called so hard that the synthetic position they have on SPX based on their derivatives could just fall apart, right? And the contagion effect it can have, right, is, since everybody's so intermingled, is it just can happen so quick, right? Like this is where the Fed sort of doesn't understand the implications of a financial accident at this point. I mean, back in 2008, the market was pretty intermingled already, but that was just like the MBS and CDO, sort of markets, just, completely, all those things were all bundled together and everyone had their fingers in every pie. But now it's not just MBS and CDO. We're talking, slabs, and we're talking the auto, like auto ABS. All of those things are not only everyone has their fingers in every pie, but every pie has their pie slices and other pies. So there's a lot of knock-on effects that can happen very quickly, and a lot of readjustment that has to happen between firms, right? And this is where, talking about how a steep downturn in the market, like even if just like ABS spreads, widen super fast, like any of those things can have like a massive SLD effect, not just on SPX, but like everywhere, right? You know, one bad thing happening, right, somewhere will lead to not only the market dropping rapidly, but it'll lead to yields going up super fast. It just every financial product in the entire market is just going to get swiftly repriced. You know, currencies, all that shit is just it's all going to go nuts.
Yeah.
So, and that's just the you know the very tight intermingling. It's not going to be a response to news. It's going to be the inner machinations, right? Just the levers turning and the gears spinning. And,
I mean,
and
the
it's gonna be nuts.
way I think a lot of this comes from the way people view health in the market, and a fundamental misunderstanding of why this recovered at all.
Yeah,
This should not have recovered when we were down here at, you know, fucking 2000 in 2020. This is the Fed, right? This is the Fed printing money, and then they were like, "Oh fuck, the Fed's not printing any more money," and they were like, "Ha, yeah, we are," right? Then the Fed going, "Oh shit, we printed too much money." People got a little spooked, right? But the amount of money stayed the same. And now inflation is back up again and rising, right? So people are getting spooked again. And then here, you know, people get truly scared. That's all of the new normal for this year gone, right? And most of the new normal for this year already is gone.
yeah. I mean, the new normal is slowly falling apart. I mean, we're
And that
seeing like
amount
that's
of money is going to return to this point over time. Now the Fed's doing it in a very controlled way, and it's very slow, but the volatility in achieving that over years is makes it very unlikely that there won't be some steeper correction at some point during that time. And all this really served, like, thousands of businesses went under here. The commercial real estate market in the US, valued in, you know, the tens of trillions, essentially collapsed and remains shit. All of that over the next 5 years is going to be repriced. All of that CMBS. And it's
all
all
those assets.
it's all fucked. All of those assets are fucked. Right? We're never
Yeah.
going to return to this, like, going to work every day culture. The worker won't accept it. And in order to maintain labor, employers have already ceded too much ground. Right? So you know, when you look at this structurally and what drove it and what caused it, the idea that a return to more standardized valuations as concentration breaks down, like, all we really saw was like the Mag 7 grow, right? We saw tech grow, and nothing else really kept its gains, right? Most of
Oh yeah,
those
all the
stocks
IPOs.
are already getting near their 2022 lows. If you look at, I mean, look at the broader base of the S&P, right? If we go out and we look at, like, the equal weighted S&P, you know, we're already starting to fall back to like November, September 2022 lows, and we're not really that far from, like, you know, like pre-COVID. It's like 15%.
Yeah, and like to go further into like the structural issue too. I mean, like it's you have to think like in over 2022, we saw a shit ton of businesses go under, like smaller firms,
Yeah.
and that's it's not good. It's not healthy. We're seeing the cost of financing continue to rise, right, for not only normal people but for businesses too. You know, and that's just going to have a drag on margins, and not
Well,
only that, but
not only that, like, our GDP as a stable, constant, a stable, constantly increasing factor, on the backdrop of our overall economic health, is now exposed to extreme amounts of concentration risk, because now our GDP is coming from 100 sources instead of 10,000, right? The majority of our GDP is. And if Amazon and Apple have a shit year, that alone, like at this point, can trigger a market crash because they represent so much of the valuations that are being priced into the market.
Oh yeah, and you could just look at the financial statements and cash flows of
And it's
these
not
companies.
just them, right? It's like the downstream effect of them. You know,
Yeah,
when you look at their capex and their credit allocation and the money that they're spending to fuel their multi-billion-dollar a year businesses, that money is going to fall off whenever they run into any financial issues. And then that means that the compounding effect of that across, you know, software as a service industries, manufacturing industries, employment, especially with Amazon, it's huge.
yeah. I mean, so Amazon's total revenue is 134.38 billion for the last quarter. I mean, like, what percentage is that of GDP? I mean, like, that's not a small amount. You know, so that alone, like if that drops by 30%, you know, you'll see an impact to GDP. And like he said, the downstream effects as well of them cutting back on capex, you know, and reinvestment, stuff like that. It's going to be, you know, it is there's a very large amount of concentration risk and not only GDP but employment too, and all these other metrics that we look at. Like they could all deteriorate very quickly if the small amount of companies producing the majority of the gross domestic product, you know, have a steep slowdown. It'll deteriorate very quickly.
Yeah.
And that's the part where that's why you know I think that's why we both agree that you know the recovery it's based on, I mean, not really a lie but a misinformed idea about how we got here. You know, the aggregate of America was not made better by the quantitative easing, not by a long shot.
No, it wasn't. And so now
So,
we've got
yeah,
to fix all that, and it's going to take us a very long time to do it. And it would appear that the Fed and both the Fed and the current, you know, electorate, that appears fixing that over time appears to be their current goal. And so the idea of another era of ZERP or free money in order to drive that future growth simply doesn't exist. And I think it's that feeling is bipartisan. I don't think there's any way to free up that free money again. Like we need to enter a period of almost near austerity in order to get our debt to GDP down to a level where it's manageable going into the future. And if we don't, we will destroy our economy over time.
or the debt market, one of the two.
Well, yeah. That is our economy, though. Like the
Yeah,
global
yeah,
debt market, U.S. economy, same thing.
yeah, it's true. I mean, it's it's a it's a pretty crazy spot, right? Because especially like for most of us, for our entire adult lives, right? We've been in an era of you know, we say stock market go up, but what we mean is yields go down, right? That's what we've been conditioned to believe is that our economy is based on debt getting cheaper and cheaper, people being able to lever up more and more, credit risk only going down, and that's why the stock market goes up. But we are, and honestly, like we say slowly, but we have quickly entered a new era, and it's where yields are rising, right? The cost of credit is going up. The ability to maintain an artificially, you know, wide margin is quickly evaporating. If you're an ultra large company, and this is why people don't really believe it's happening, is because if you're an ultra large company, you have the moat to be able to withstand this, and the impact is going to have a greater lag. But when you're a small company, and you know you're sort of your day-to-day operations sort of depend on being able to get like net 60 with good interest rates, and those interest rates keep going up, I mean your margins in real time practically are collapsing.
Yeah.
So, I mean, I don't know. We probably have some small business owners in the chat, but you know, it's something that small business owners especially are really struggling with right now. And you know,
Yeah, especially
if
if you're not
you
in a cash rich industry, right? Like if you don't have, if you're a small business and you don't have good cash flows, and say, you know, your cash flows are seasonal, and you know the rest of the year you survive on credit, this is, I mean, this isn't a period that you can survive.
no, yeah, I mean,
And
really, it's
how many seasonal businesses, small to mid-size, maybe even large businesses, are you know the backbone of companies like Apple and Amazon and Microsoft, and provide their revenues, right? And if those start failing, the revenues in the Mag 7 drop. You know, everything in the economy is tied together, and and you can't have, you know, a collapse of the middle and bottom rung of enterprises and still see broad success in the largest cap companies, because they are where they are because of the support under them. And I mean, like, how many fucking mid-sized businesses use Azure, right?
yeah,
And if their credit's tight and they can't afford, you know, to spend as much on cloud every year, or you know, office, how many millions of offices are gonna go under, or downsize, and like how much is that gonna affect Microsoft's licensing revenue? And then, you know, Microsoft starts making less and they start spending less and less on upgrading, you know, their cloud infrastructure, and then that affects Nvidia's revenue, and then Nvidia stops, you know, buying more and more chips from TSMC, and then TSMC stops buying the commodities to make those chips, and then the shockwave moves down, right?
yeah, yeah, it's like it's a horizontal, you know, consolidation and then a vertical sort of distribution, right? And yeah, the knock-on effects are going to be crazy, but like it, and that's this is, you know, it's kind of why, you know, I think for you, and I don't want to put words into your head, but like kind of why you think that it's not right to be bullish here, because being bullish here is ascribing to the belief that this concentration is healthy and sustainable.
I mean, that's why I've been bearish all year, right? I mean, well, since I was really bullish going into the beginning of this year. I know everyone's forgotten, but like after October of last year, I was super I was like full bull. When we hit market bottom, everyone thought it was crashing, and I was like, nope, it's going all the way back up. And I was like fucking long everything. And it did, right? Because we'd reached a valuation where fear had subsided sufficiently for, and data started to turn around, and there was actually good reason to be bullish. It looked like what the Fed was trying to do had scared people enough to work. Now, I mean, on the other side of that, we knew very well that what the Fed had done was not enough, right? But it had created enough fear in the markets that things had become priced in a sustainable way. And instead of them remaining priced that way, which would have been very, very healthy for this year, you know, if we'd moved up from 3,400 to 38 to 4,000 through this year, that would have been very, very sustainable. Inflation probably wouldn't have gotten as crazy. The consumer would have stayed, you know, kind of subdued, because there wouldn't have been that asset bubble reinflation. And we probably could have gotten a soft landing had we followed that trajectory. You know, like if we'd kind of just done this year, this could have been our soft landing, right? You know, inflation reignites, we reprice in a little bit, you know, move down to like 38, and then continue forward. This was bullshit.
Yeah, and
This I
I've been warning.
refuse to be bullish on, and rightfully so, right? I mean, every investor that went long here is now underwater. And this
Yeah,
is what I was not bullish on. The AI bubble, fucking big tech carrying our economy into the future. Absolutely not. And this just highlighted the fact that the consumer wasn't going to stop. They were simply slightly out of money. And the second they got some more, they went out and bought as much shit as they feasibly could. And then core rocketed it up and inflation rocketed it up. And, you know, we'd already used all our ability to suppress oil prices back here in 2022. So now energy is going up and we can't control it anymore, which leaves it, you know, up to the people that supply us oil, none of which are our friends. Um, and you know, so we've created the worst possible situation instead of, you know, moderating at a average pace for 3 to 5 years.
Yeah, I mean, and I you know, ever since January, I've been talking about, you know, the face melter, the face ripper, right? You know, like keep an eye out for it, and we pretty much had it, you know, through July, where we're, you know, valuation's just going to go up and up, and no
I
one's going
mean,
to have any fucking
it seemed
supply.
perfectly reasonable in Fab that we had it, and me, you, and Gfresh were pretty much in line with the idea that, like, okay, that was the face ripper. Calls aren't free anymore. People are done, right? And then all the free money came into the banks because they failed, you know. And
Oh no,
then
I mean,
that's when we got this.
no, so I mean, like, well, no, well, so back then, right? And you know, I knew that the recovery was, you know, it's all good. And then I became Jay Fresh's stonk daddy in March. But you know what I was really like if we go back, like what I was really talking about was something like this, where we push for all time highs. We like a real like full on push for no reason, right? And that's like, you know, and things were looking okay in Jan, Feb, and so I was like, yeah, you know, we'll probably have this nice recovery, and everything was good. Then March happened, right? And we recovered off that, and I was back into uh, alarm mode because we shouldn't have really recovered from March, right? We should have,
No, no.
even with the bailouts, we really shouldn't have recovered necessarily because, you know, there's a lot it exposed a lot of the tail risk in the market. But you know, and so like, you know, my idea of the face ripper was, and it happened, right? In before Nvidia and AI, we had already started seeing the beginnings of the face ripper like showing up, and people in the news, you know, and this is mostly what I was kind of, you know, alluding to, is the people in the news, even, you know, the folks that, you know, have information that they're meant to feed to the public, they're even kind of like, it's just going up, man. The shit's just going up, dude. I don't know. And it was happening. And then NVIDIA, AI, perfect scapegoat for taking equity valuations and sending them to the moon. And like, so, you know, I think we have experienced the real face ripper. You know, there were no real pullbacks. There was like one pullback, but it was, you know, now we're actually in the correction phase from the face ripper. And so I'm really excited because what happens next, right, is highly uncertain, right? We are at a point, especially right now at these valuations, we're at a point where I think everybody is going to react very strongly to any piece of news that points one direction or another. I mean, we've been seeing some denial of reality in the economic data just because it hasn't been like that bad, right? Unemployment hasn't gone up, right? Net margins over the last quarter for large companies, not really that affected. But if any of those data points start to really obviously signal an economic slump, I think that we're just going to see people really start to just get the fuck out of their longs, like asset managers and things.
Well, I
Anybody who's
think
still
now we're
got,
seeing institutions bail on their longs. Remember that all the institutions are long back here in the first few months of ZERP. Institutions piled all their money into equities back here. And now they're largely risked off.
yeah, I mean,
And
I think,
we've already started to see, you know, more and more institutions on the short side of this trade rather than the long, right? There's not a lot of big bull pumpers left. Most of them are out of the equities they pumped. I mean, the thing that really happened is, like, we knew the liquidity crunch was coming with treasuries, right? Like we didn't know it was going to hit regional banks first, but we knew it was coming. we started talking about that back in like August of 2022. Um, and it did. It all came to a head in March. Well, at least initially. There's probably another event in the future, but especially
There
if
was March
yields keep
and May.
climbing. Yeah, yeah. There were some more failures in May, but the yields are now higher, right? And now they're high enough that they're going to start to affect anybody who felt safe back in March. But
Yeah, and wasn't there some data?
what
Wasn't
no
there some
one what
data
no one
came out?
ever expected was bank runs to force banks into equities, right? And so, banks had to maintain these minimum standard deposits for Basel, in order to meet their requirements. And so to do that in the face of depositor flight, they went hard as fuck into equities with every ounce of liquidity the Fed gave them, and every little bit that they could muster themselves. And that's what really drove March through August's price action.
Yeah,
Was
and
they
you
made
like
they made
because
up for that depositor flight by going long as fuck on equities, which no one ever would have expected. You think they would take their treasury risk and roll it forward and be like, well, these yields aren't great, but they're we've de-risked our yield like our mature holding portfolio. And 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 now, like, yeah, I mean, some of them have gotten out a lot with a lot of cash over the last 2 months, but not all of them are all the way out. And so, somewhere in the downside of this, someone is going to have a lot more risk than they intended, because it's hard to get out of that many equities at once without just cratering the equity market. And so
yeah,
they're trying to bleed them off level by level. They're selling the supports in order to keep vol low and prop prices up, but it's slipping, and it's slipping more and more every day.
yeah. I mean, and there was some interesting data points. I think it might have been you or Jay Fresh brought up that like, the change, like the net percent change in returns on investment activities for a lot of banks just went through the fucking roof over the past couple quarters.
Yeah, like 1100% at B of A.
Yeah, like that's crazy. And it's a that's a huge alarm, right? That like something ain't right. That's not how banks make money. Really, banks should be in the shitter right now. I mean, if they were doing what they should be doing, and they should be, absorbing a lot of losses, but instead they refuse to absorb losses even on dropping deposits. We see, FHLB throughout that time just went, gangbusters. It just finally started dropping off, but that went gangbusters. We see in returns on investment activities, just they were killing it, right? Like that. It just goes to show that, you know, there is a big monster lurking underneath all of this, and I think it tells you exactly kind of what we said earlier, that most of the liquidity in the market at this point is synthetic.
Yeah. Username and username face. So it's easier for people to scale down Azure and move elsewhere because there's less value in the platform itself. Probably positive. I'm sorry. In my opinion, Amazon will be affected least by reducing cloud spend. AWS has most services and general platform differentiation. Google mid. MS affected most as it's the most cheap compute. Okay, here's the thing, man. Yes, businesses will scale back, and yes, AWS probably will perform better than the rest. But I'm not talking about businesses just scaling back. I'm talking about businesses failing. Many of these businesses cannot withstand refinancing their debt at a higher rate, and they are almost all going to be doing that in the next 2 years.
Yeah, that's the thing, is like we're
So
not
it's
just
it's
talking
not
about.
that their demand is going to be reduced. Their demand is going to be gone forever.
Yeah, yeah, your cash flows aren't just, having a short-term decline. We're talking about cash flows like evaporating, going away, bye bye, poof, which is a big
And then
difference. That's a
everyone
very big
else,
one.
and then everyone else reducing, everyone who survives drastically reducing their spend.
Exactly.
So
Yeah. So
even though, yeah, AWS may perform better than the rest, but they'll still get hit hard.
yeah, no, everybody will. I mean, there's no real safe space in the event of like a broad economic slump, like where you see businesses in the credit market overall
So who's to
really truly deteriorate
yeah. Who's to
because there's a
blame for the
positive
worst
feedback loop that
case?
happens there too, right? Where the cost of credit will continue to go up as less and less interest in financing, as financing sort of demand goes down, right? You're going to see those yields go up and the cost of financing continue to rise, like in a
And
positive feedback
and
loop.
the reason we watch the carry trade, that kind of feeds into what you're saying, Derek. The reason we watch the carry trade is because if the carry trade were to collapse, that means that the tightening that should have occurred throughout this period of time that has been allowed to kind of be ignored due to the negative interest rate in Japan will collapse all at once. So lending will go from what is currently very liquid, right? I mean, lenders are still offering products because they want to pick up as much of those yields as they feasibly can. Without that backstop from the BOJ, lending would go from its current liquid state to significantly illiquid almost overnight.
Yeah, that's the credit crunch, right?
Yeah.
And that's, yeah, once again, that market is, if it's as big as we think it is, it's not just fueling, and I said this last week and I've said it a bunch, but like just to really drive it home, that doesn't just fuel like home mortgages and auto loans. That fuels, the market and, hedged positioning, which a lot
Leverage.
of
Yeah, leverage and margin.
yeah, a lot of portfolio management and replicating, portfolios where you're trying to like, hedge options with a position in an underlying security, that relies on debt, and your risk models take into account that interest rate, and if that interest rate rockets up, all of a sudden you have to it's basically a margin call at that point, right? Because
Yeah.
your cost of maintaining a certain hedge position goes way up. So
The
I
value
mean,
of
that's
your
why you
collateral evaporates.
exactly, yeah, and that's
Yeah.
that's where and that's where you see like the dollar collateral issues start to show up, and why the market goes down in the event of a tightening, in the event of a tightening credit conditions is because all of these positions, they have to be rebalanced all like immediately in order to maintain a safe position for
Yeah.
yourself. And it's really hard to adjust when everybody is right alongside you trying to readjust their balance sheets. It's a little chaotic.
Yeah, it hits everyone all at once, and it can be a huge amount of risk in a very short period of time. So
Yeah,
who's to
synthetic
blame
liquidity.
for the worst case scenario? The consumer, the Fed, or corporate greed? All three? I mean, the Fed, if anything, has tried to moderate risk as much as they can while still maintaining their target. And I would say they're at fault for taking the weakest approach. Corporate greed is pretty simple. It's oh shit costs more money. Well, we're gonna charge more money. People have more money. Good, we can charge more money, right? I mean, and the consumer for agreeing with that. Right,
Yeah,
the consumers at fault for going out and buying fucking non-essentials at 3 times the price that they were 2 years ago. If you're
yeah,
if
and
you're out if
also,
you're out buying durables right now, when inflation's up and then margins, like corporations, instead of contracting their margins, have decided to expand them, right? Then you're just reinforcing corporations doing that. Like no one ever really thinks about voting with how you spend your money. But its influence is very important, probably
yeah,
more
and
so than your political vote.
oh, for sure. But like even more so with the consumer too. It wasn't just that they were agreeing to this pricing, but they were leaning into the idea that their cash flows will be unaffected by any sort of economic slowdown. The hubris of the consumer has led us to a point where now, uh, you know, if a consumer sort of imagine themselves like a business, right? Their debt to equity ratio is just not the only thing propping it up is if they have a house, right? I
Yeah.
mean, at this point, so. a lot of consumers are thinking to themselves, yeah, I'm not going to lose my job. Fuck it. I'm going to go, lever up on this, loan for a goddamn 250-inch TV. Like there's a good amount of that still happening, and a lot of people who believe that their cash flow is not at risk. And so we haven't seen any risk aversion from the consumer themselves, right? And it's starting to bite back.
Well, we're starting to see it now rapidly, right?
Yeah,
Because all their credit
yeah, the
cards are
economy's
maxed
going
out and
up.
they have no savings, and their wage didn't go up as much as they thought it would, or they lost their job, um, or
Or they
all
just
of a
don't have the
sudden that
credit.
house that they just bought for $800,000 at 8% interest payment is looking a little burdensome.
Well, not only that, but like if someone has like a bunch of credit cards and then consolidate it all onto a personal loan,
Yeah.
they're probably getting screwed on the interest rates as well. Like that's,
Oh
that hurts
yeah.
really bad,
The
right? When you're thinking to yourself, oh
the personal loan rates are ridiculous right now.
yeah, yeah, no, it's like you really like that's the part that I think hurts the worst is that a lot of people were banking on being able to consolidate their debt and get it at a better interest rate. And as yields continue to go up, right, and the credit market continues to slowly tighten, they're seeing that that advantage is quickly evaporating. So it's
Yeah, all of a sudden they start paying back student loans this month as well. Yeah, that's really gonna hit corporate profitability going into quarter 1 of next year.
yeah,
Santa
I
is
mean,
not coming to town.
but for some people he is, some people he's not. I mean,
Yeah.
I don't think we're like I don't know if we're really on the precipice of disaster right now, but we're getting to a point where things are people are tightening their belts. Spending habits are changing, and all comes first full circle into this idea that this is some sort of a new normal. If it is a new normal, I don't necessarily think it's the one that everybody's expecting.
People are using credit to buy groceries is rising fast. It's a terrible indicator for the health of the consumer. I mean, I have a 6% grocery cashback card that I use for groceries because it discounts the price of inflation a bit, right? Like I would never use cash to buy groceries if I could use that. So I don't know how much I agree. Yeah, it's historically it's a very bad indicator, but a lot of cards have like cash back on groceries, so it can also be an effect of that.
Yeah, and I mean the thing about credit cards is there's a large constituency of people who use them and pay off their balance every month, right?
Yeah,
Like
yeah,
the better things to look at are delinquencies more than
yes,
anything else.
yeah.
Like because credit card debt's going to continue to go up, and like and this is I mean like my response when we hit like the all-time high of credit card debt, I was like, that's kind of to be expected. I mean, you're not really like you can't really glean any good information off that other than there's a lot of transactions happening on credit cards. But when you see delinquencies rise, you know that the ability of a consumer to finance their debt is being impacted in aggregate,
If
which is
savings are declining at this at a rate equivalent to or greater than credit card usage, that's important.
oh, like my chart.
Yeah, that's
Yeah,
what I was that's what I was shilling your chart.
thank you. Yeah, I
You're welcome.
appreciate that. It's yeah, we're definitely in a place where I mean like I feel pretty secure in my job, like thankfully, but if you're like a home builder right now, right? Like at first you were thinking to yourself, man, I'm gonna build all these fucking homes, make so much money, just selling them at a slight discount.
Not even a
And now
slight
you're
discount,
realizing,
right? You were thinking I'm gonna build this home now after I finish the permitting process and getting the foundation laid and putting it on the market. It's gonna be worth 10% more than when I started fucking building it. That's what they were thinking, right? And I'll still be selling it at a discount to market price.
yeah, and it ended up being that, I mean, everybody's locality is going to be different, but there's something you can sort of pay attention to, throughout to sort of get an idea of the health of your sort of, housing market. And you can sort of see like what I do is I look at Zillow and I look at how many homes are up for rent and how many homes are up for sale. And what I've been seeing, at least in my locale, is that the amount of rentals that are going up and staying up is increasing pretty rapidly. Over the past 3 weeks, it's like gone up like 3-4 fold. How many rentals just stay
That'll
on the
be the
market?
that'll be
Right
the
where they're at.
first avenue for underwater homeowners, right? That don't want to sell, is
Yeah,
they'll start listing properties for rent, and then rent market competition rises, right, which drives rent prices down, and then rent prices start going down, and the underlying asset values start to drop. I hate the way the housing market works. It should just be fast, like the stock market, but it's not. It's faster than it used to be and more efficient than it used to be, but it sucks so hard. Um, but yeah, I
yeah,
mean, like in 2 years, I mean, well, maybe not 2 years, right? Like in 2008, it took about 2 years. Now it's like maybe like 6 months to a year, because we're already starting to see people trying to sell the top because they realize home prices are dropping, right? And we're seeing a rush in supply, and it's only a matter of time before the supply available in the market starts to try to beat the market by selling.
yeah,
It's no different than trying to sell your option at the bid, right? And the more and more people that start selling that option at the bid, the faster and faster prices are going to go down.
exactly. And the more spreads are going to widen. And
Yep.
like, so a good metric, my Zillow trick is Zillow has this thing called the Zestimate, right? Like the rent Zestimate.
Yeah. Yeah.
I think it's not necessarily the best pricing metric, but it's a
Not at
good,
all.
it gives you good, but it gives you a good idea of where a computer would imagine a price to be, right? And you can look at if rents are above or below that estimate, and it kind of tells you sort of what's happening, right? So
Yeah.
I've seen a shift in pricing from above that estimate to now at or below by small margins, right? So the competition is going up, at least in my area, and I implore everybody, if you are concerned or you're looking at a house or something, keep track of these things. Like I check every other day to see what's gone on the market, what's gone off the
Better
market.
yet, if you're looking for a house right now, remember that rents are going to be cheaper before home prices are cheaper, and that you're probably better off not buying a house until interest rates have moderated a bit. Because paying double for a house at the top of the market is about the stupidest fucking thing you can do.
Yeah, you gotta wait. I mean, it's painful, especially if you have like a family and you're trying to like get that extra living space. But like, you gotta.
The opportunity cost lost is like could be your life, though, right? Like the entire value of your life's work.
The recovery could, yeah, your personal recovery could be 10 years, right?
Yeah.
Like before you see, where you've paid down your equity to the point where you're no longer negative on your balance. Like that's a long time with a lot
Yeah,
of
but
pain
and
where you're.
that's also under the assumption that we're not going to massively increase housing supply in this country in the event of a real estate crash, right? Because we probably will. We already have an issue with housing supply, right? And if prices get cheap and the cost to build new homes drops significantly, the supply of houses is going to go up, and that's going to moderate home pricing for a long time. I mean,
Yeah,
the build out of housing in the 50s moderated home pricing all the way into the 90s.
yeah, exactly. I mean,
So if
so
we hit another large scale housing supply subsidization period, we may never see prices on houses this high again. I mean, it's very speculative, but
not in our
also,
lifetime.
I mean, we already see asset managers who were like totally ready to fucking turn everybody into serfs and buy up all the property in the US, bailing on massive residential portfolios and massive commercial portfolios, right? They're no longer on that track. Like I still see people talking about it online, and they're like, "Oh, all the hedge funds are going to buy up all the homes, and you'll own nothing, and you'll be happy." But the reality of that is that all those asset managers don't want those fucking homes anymore. They want to sell them
At least not
now.
now.
Yeah,
Yeah, this isn't the dip.
yeah. They fucked up. They chose the
Yeah,
wrong decade.
yeah.
They'll come back
Uh,
and try it again later, but this wasn't the time.
no, exactly. I mean, and so to get back to my point, like there's a large constituency of people who have jobs doing things related to these, asset sensitive markets. between CRE, residential real estate, auto loans, the auto industry, all these people who, have at this point seemingly stable, secure incomes, and they're definitely being squeezed and don't even realize it, right? Because the cash flow has been so consistent for all these people that that you're sort of conditioned into thinking, yeah, you'll be all right. You can up your credit usage by a few $100 and be okay. And incrementally that grows. And especially with rates rising the way they are, I mean, there is a very real risk of like negative amortization on these people, right? And that's when you start to see the panic set in amongst consumers
Yeah.
when they can, like, if you go on unemployment and your interest rates are crazy high, to the point where you're only making the minimum payment, you're negatively amortizing your debt, and so it's just growing right on top of you, and that's extremely scary as a person. There's no light at the end of that tunnel when you're unemployed and your debt's just growing on you from interest. And we could quickly enter that if the economy does really enter a trough, right? And that's the long-term risk, right? And how you end up in something where you lose 5 years of gains in the market. And I mean, so
I
yeah,
mean,
so in terms
the
of
real
personally,
the real risk is reflexivity in the cycle feeding back in on itself, and then
exactly.
seeing very much like the first part of this year, where you see positive momentum and everyone gets into it too much, and then it fails, right? And that's effectively the situation we're looking at right now, is that everyone was like, oh shit, everything's getting better, all these problems are fixed, let's fucking go, right? We see June home buys rocket, right, at 7% interest. Everyone's like, it's cool, rates will be down next year, I'll refinance. And now 2 short months later, everything's back and worse, right? And this is what led to the depression in following Black Tuesday through the 1930s, right? Is that all the money kept coming back to the table, assuming that there was going to be this recovery, and then it fucking crashed again, and it crashed again, and it crashed again, and all the money and all the wealth got destroyed. And then we got World War II, which economically for the United States kind of fueled us for the last, we gave out money to fucking we refinanced the rebuilding of the entire world.
Yeah, no,
And
and
so, but we don't necessarily have another event like that in our future, right? And so stopping this before it becomes that is really important. I think that's why the Fed was so hard in their projections. And I think their projections will get harder too, because that recovery is not an option again. And so we need to recover
you
in
can't ever
an
assume that you're going to get a world war to save your
yeah,
fucking economy. That's
yeah,
the worst way. Yeah, it's terrible.
and so we need to approach growth moving forward much more moderately. And I think the Fed's trying to prep us for that as best they can, but obviously their tools are limited. The worker is trying to prepare us for that. They're demanding more. They're demanding less corporate profitability and more sustainability for the labor force. And these are I know all of this is bearish as fuck, and everybody who owns a house is pissed at me right now. And they're like, fuck you, Girk. Like, my house is gonna be worth way more than I bought it for. And like, I don't like to tell people this shit. It's not like I get my jollies from being like, haha, it's all gonna burn down. I mean, I do, but um
That's more for being right.
yeah, that's just about being right. Like, I don't want to see people broadly suffer, or unemployment go up, or people face inequitable hardship due to where in this cycle they were socially positioned. Um, but over time, if we can do it, if we can moderate our growth moving forward, then, you know, things become much more equitable in the future than they have been for the last 15 years. I mean, all of us at some point have felt underpaid or overworked, or like there's no real hope, right, for our future. And you know, the continued demand of the labor force for higher wages, the you know, reduction in potential corporate profitability into the future, the pullback in excessive government spending, these are all the things that could pull us back to a society that has a much more structured lower middle, upper middle classes, right? It really can create a long period of destruction of wealth of that's hoarded at that 1 to 0.1% level, and distribute it more equitably among everyone, right? And so everyone really ultimately can benefit from this, even if the shit you bought might be worth less in the future. So there is, it's not all bad. I mean, in a way, if you were looking out 10 years from now, this is awesome, right? It's
Yeah,
just right
it's
now
both
that it
thesis.
really sucks.
It's a bull thesis. It's a good one too. Like it's, I mean, yeah, it's the whole idea that, you know, you need short-term pain because, you know, losses will be distributed, you know, no matter what. And it's, yeah, like it's not like our words are gonna have it, like it's the thing is you can't get mad at anybody for really making an analysis. I mean, except for Larry Fink, you can get mad at him, but you can't get really mad at somebody for, you know, saying that this is happening or this may happen. It's not like, and this is where, like, I mean, I see economists get mad at people who get bearish, right? Because they think that it's some sort of self-fulfilling prophecy. But in the end, in the world of so many people who are completely uninformed and such a, you know, such a high entropy state, really what we're doing is just making observations, and like it's like watching a train crash in slow motion, right? You can just watch it happen. You're like, oh, look at that, that's really terrible. And then someone's going to look at you and say, yeah, man, those train operators, they're hitting the brakes, we're good, you know? Like, I mean, maybe, but like, I mean, you can't, you can't necessarily ascribe bad faith to people who want to see a more stable future, right? And the idea that we can mitigate short-term pain and have long-term sustainability is, especially with the way we've been doing it over the past 15 years, is silly. It's just the new normal we're going to have is going to be, hopefully, and this is like the most bullish case I can think of. Hopefully, the new normal we get is one where corporations have to think more critically about how they're going to use their capital spend, right? And how, and people who are getting jobs are going to be more, you know, like you said, they're going to be more concerned about having a fair representation, you know, monetarily. Like it's great. I mean,
I
and
mean, I mean,
you know, the other
you're
half said you're
right.
gonna eat shit, but
The
like,
average American person, for the first time since the financial crisis, has an opportunity to take back what they lost over the next 10 years, and force the effects of those financial choices on the people actually responsible for them. All it takes is us agreeing, even just a little bit, that this isn't how we want things, right? And we are to an extent, we're starting to, you know, the UAW strike is huge. Not because they'll be successful or Ford will agree with them, or Stellantis or any of them, or they'll even win, but because they did it, and it was loud and everyone saw it, right? And then, you know, more people are going to be like, well, I want to get paid more. and
yeah,
and 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 we should, right? And you know, corporations are like, fuck, these people want too much money, maybe we should charge less for shit, and maybe then they'll need a little less money, right? And then you have you re-enter, you know, what's so great about capitalism is corporations actually competing with each other for our dollars versus the assumption that they'll just get them.
yeah, yeah, it's beautiful, and I
Take
really do
back
look
Ben
forward to it.
Bernanke's Nobel Prize. That's a hot take.
Uh, yeah, it's but yeah, there's the problem though is that
there's going to be a lot of pain in the short term as that equalization happens, because you don't just reach equilibrium nice and peacefully and painlessly. You know, you need to see assets reprice to match these interest rates going forward. Like, you know, we're at the 30-year at, you know, 3 or 4.7%. Like, that's huge, and we shouldn't ignore it. And we should know that long-term asset prices are going to normalize somewhere lower than they have been historically. And that's just, we're going to be below average, you know, on asset pricing and durable goods for quite some
I think
time.
we can make those people feel better about themselves. You guys who just bought a home for $600,000 at 8% interest, thank you for financing the future.
Yeah, thank you, for yeah, you're doing your part.
I mean, it's it's extremely philanthropic of you.
You know what? And ultimately, like, if you're a young person, like you're in your
Especially if you
30s
can
or
pay it.
40s, yeah, like if you're in your 30s and 40s, you know, and you did just buy the top of the housing market, like, we're not saying you're going to be like fucked forever, just for just for enough time to make you hate it, right? And then you'll recover. Things will get better. The thing that's going to happen while you're at negative equity and you have no access to large loans, the cool thing that's going to happen is stuff is going to get more reasonably priced. You're probably going to get paid a little better when you find a job, or if you keep your job, you know, you're going to get paid a little better.
Yeah,
You know,
the
stuff like
value of
that.
retaining your labor will increase.
Yeah, exactly. So you'll do okay. People will do fine.
We
I
bought our
mean,
home in 2018. Sorry.
like,
You know what happens here, Dirk? I interrupt you sometimes. There's like a little delay, and I try to fill in the silence, and you don't like to end your sentences on any kind of inflection.
nope.
So I'm sorry about that. I'm not trying to interrupt you. I'm just trying to keep
I
dead
understand my
space from
voice is different.
happening.
But yeah, I mean, ultimately, like recessions, right? You know, things like that. You know, depressions are a different beast entirely, and let's just not go there because that's a very extreme outcome that I don't think anyone's going to allow to happen. But recessions, you know, like the saying goes, that a recession is when your neighbor loses his job. A depression is when you lose your job. Um,
I thought a
and
depression was when you and your neighbor move into the same tent together.
that eventually happens if it's long enough. But you guys hang out, become good friends. Uh, but if we enter a recession, I mean, statistically speaking, you should be okay. And if you get directly impacted by a recession, honestly, my heart goes out to you. And you know, you have to tighten down the belt, but ultimately coming out the other side, you'll be okay. Everything, you know, is going to be all right. Like, it's the economy is not going to grind to a halt. We're not going to see chaos in the streets, right? Like, that's just
I
it,
mean, recessions are ultimately punishment for greed, right? So,
yeah.
it's all relativistic. You know, if you were insanely greedy and you have 50 Airbnb properties, you're gonna get fucked pretty hard, right? But you know, if you were already broke as fuck, you're still just gonna be broke as fuck. Like, it's
Yeah,
not a lot's gonna change for you.
yeah,
Um,
exactly.
and so, you know, everyone unilaterally will get punished for the amount of exposure they have to the system and the amount of assets they've leveraged up. So it's like a punishment for wealth, or well leveraged wealth. If you have actual wealth, you don't give a shit about a recession either. But very few people have actual wealth.
Right. Yeah. It's a great South Park episode to watch is the one where Randy Marsh becomes the Jesus of the economy.
I've seen that one.
The economy we have angered the economy. Like, you know, he
Assaulted
goes,
Peanuts says our home is up 80 to 100% in value from 2018.
good for you, man. Glad to hear you're
That's
doing okay on your
Do
home.
you
That's
think
nice.
that's healthy? Like, are any homeowners, like, I have a house, but I got it for way less money than it's actually worth, and like so much so that even if it loses 50% of its value, I'm up. But are any homeowners saying like, yeah, this is a reasonable price for my home?
I
Really?
mean,
Like, I can't imagine owning a house and watching it go up 300% in 5 years and being like, yep, that's what I deserve.
I think that a lot of homeowners who see that happen are thinking to themselves, "Holy shit, I'm never going to be able to sell this thing if I want to."
I mean, I would just think about it like a stock. I'd be sitting there like, fuck, I need to sell this thing before it goes down.
Well, if you live in it, you can't, right?
Yeah, that's
There's a
true.
big dynamic to it.
I
But
mean, you
yeah,
can. You can just live in someone else's house.
so uh small anecdote, my parents, right? They moved into the house up the street after they renovated it, and they sold their old house to these people back in I want to say it was like 2018 or something like that.
Yeah.
And they sold it for, I think it was like 500 grand. It was right around market price, right? And it's like a four-bed house or a three-bed house, you know, decent size, a lot of property. The house across the street went up for sale, and it's a smaller plot of land. The land isn't as good. The house designed poorly, and they're trying to sell it for 750 grand today. And
Jesus.
that that my parents sold was the last house to go up on the market on that street. So like they the amount that people are asking for homes is still ridiculous. And yeah, I mean, if you're up huge on your house, like it's got to feel good because your access to like a HELOC is like the banks are practically begging you to get a HELOC right now. But
Oh,
I
but at
mean,
the rate? Like, fuck that.
I well, yes, I understand that, but they're practically begging you for it because they can still give you a HELOC and make money.
Yeah.
But like it's just it's got to be crazy. You got to be thinking to yourself like, I mean, if you're up a shit ton, even the problem is even if you're up a shit ton and you want to move, you can't upgrade at this point. It's not like being up a bunch means you can move laterally even.
No, no.
So like you're really in a bind. I mean, even though you're up a shit ton, like it feels good. You know, your quote unquote investment is really valuable right now. It's not really that valuable. The only thing that's valuable is the interest rate you're paying, right? Like if you got at a crazy low interest rate and then treasury yields, you know, go up a bunch, you could have gotten a, you know, if you bought a house, the price went up a bunch, yield stayed low, you could have gotten a HELOC and just sat on the money until treasury yields went up and you could have made a fat arbitrage. But like at this point, there's nothing you can do.
Just sell covered calls on your house, because it's an investment. That's renting. That's what renting is. That's selling a covered call on your house.
Oh, dude, but the premium on covered calls on your house are so low right now.
Yeah, they're going down. Like
Like the cap rate on those is crazy.
volatility is reducing because the market's too liquid.
Yeah, no, like it's the cap rate on rentals right now is just it's just dog shit.
Gherkin's Law is so
So
cool.
it is, it's great. I mean, it makes total sense. It's a natural law, and you know, you think about it, and the more you think about it, the more it makes sense. And we're kind of at that point of peak illiquidity everywhere between
Yeah.
treasuries, equities, the home prices, durables, energy. Like it's all just getting less liquid. I mean, energy is not really getting less liquid. It's actually getting more liquid, but not in the way that people want. So that's great. But yeah. So
Let's talk
with
about
all
this
that,
week.
yeah, after all this doom
After
and gloom,
all the doom and gloom. Yeah, so I mean, one note, guys, and I kind of touched on this when I was going off on my rant a little while ago about how this is actually bullish. Remember that the macroeconomics don't affect the near-term price of the stock market. And just because things are bearish in the long term does not mean that you should be over leveraging weekly puts. Um, Everyone this week got punished and then subsequently rewarded for positioning badly. Remember that markets are picking up volatility, which means that you need to be significantly more guarded with any exposure that you currently have out. That means that your ability to manage your risk is far more important than your ability to pick a direction in the fucking market. All right?
yeah, volatility goes both ways.
Yeah.
It
And
definitely
the
can.
more volatility you get, the more wild the swings get.
Yeah, and I was talking to the other night when I got super hammered. I was talking to one of the guys who was saying like, how like he was talking about trading a market crash and like he was like, if the market crashed a bunch in one day, I'll just buy a put and be good. And I was like, you could do that, but you could just end up getting absolutely wrecked,
I think I made
right?
more
Like,
money scalping 2020 than I did on my like initial position. Because I like scaled
yeah,
out of my initial position when we were down like 15%. I was like, I need to start selling some of this shit or I'm gonna get burned, right? And then like, but then like, I was like, oh, it's still dropping. I'm gonna scalp it, right? And then like, you'd buy a fucking overpriced put at market open, and the market had dropped 6% that day. You'd close it, you buy a call, and it bounced 9%. Yeah, it was fun.
yeah. I mean, and that's what I was kind of saying is like making a directional bet in something that extremely volatile is, the premium that you're paying. I guess that's how I described it. Was like the premium you're paying for that directional bet is so insane that like you really need to seriously consider if you think the market is going to make that premium not only worth it but pay off in dividends, right? It's a very, very hard question to answer. Even though you may see the market down a shit ton, you could still end up getting cooked because IV has already peaked, right? So
Yeah, and it
anyway,
gets
so yeah,
hard. It gets hard to play the upside because vol doesn't always crush on the up move,
yeah, exactly, right.
or it
So
does. So either you pay more for the call or you lose money as the. So like, be very careful as our volatility picks up, especially with buying out of the money shit. Stay close to the money. Keep your positioning tight. Um, do not do that shit. Like if VIX hits 25 and you're buying $20 out of the money calls at open, you're spending even on zero DTs, you're gonna be spending like 1,500 in premium for like one position. And then if vol crushes hard, like what if vol moves like 3% down or $3 down on VIX, right? On the intraday, like that position, you may not hit your price, and that position will be fucking worthless on the move up. I've seen it happen a lot of times, and like it happened in October. People were buying puts, and they were massively expensive, and then the market started bouncing, and then they had calls, but they were too far out of the money, and the call was fucking worthless by the time the price got there.
yeah, and a good way to think about this is like you look at an at the money call or put and you look at the premium on it and you imagine to yourself, this is how much the market needs to move in order for this to pay for itself on settlement,
Yeah,
right? And that's a good way to look at it. So when you're looking at like at the money contracts trading at like $30, like that tells you that pretty much tells you the premium on the risk, right? And like it's a very hard question to answer. Like if you even just buy like a straddle, right? You're saying the market's going to move more than X amount of dollars times two,
that's why
and
we that's why we move into strangles. But
even yeah, but even strangles, you're still looking at like risk premiums that are just insane, right?
yeah,
So
they are.
it's just a very difficult thing to actually trade and sort of make money on. Like overnight straddles probably smarter or overnight strangles, but like intraday risk premium is just going to be so all over the place. But anyways, yeah, the economy is not going to make the market crash, and more so than a dollar collateral crisis. So and that's unpredictable. So don't fucking buy puts just because you're hearing us be bearish.
Yeah, buy
That's a
puts
dumb idea.
because you think there's actionable downside in the index that you're buying puts on. Um,
Yeah.
and so let's look at that index. What do you think? I'll let you go first this week, Dork, because you never get to go first.
Well, I think
Hmm.
this week, I mean, what have we seen so far? So last week we saw a 68 basis point drop in the index, bottomed out at like a 150 basis point, downside, slightly green one of the days. I'd say we're reaching an inflection point. We're right up against that long-term uptrend from the October low.
Yeah,
Uh, it's a pretty important week, I would say. Um, It could go one of two directions, and if I have to pick a direction,
my bearish tendency and my moral obligation to be bearish tell me it's going to be down. So if we break, say, what I want to say 42.50 next
Mm-hmm.
week, we're probably going down a lot throughout the week. We're probably going to have another 200 basis point down week. If we break 42.50 and we stay down, we don't
Yeah.
just like bounce
Yeah.
our asses off it. We're going to go down. So I'll pick that direction. I'll say we test 42.50 on Monday or Tuesday, and then we break through it, and then we end the week down to 41.80.
So hold on. So 2 days. There by the end of the week.
Maybe a little further. I'll say 41.50. Fuck it. If we break that resistance, it's like there's gonna be a big red candle.
Yeah. Yeah.
Yeah, something like that.
So I'm kind of in agreement. I think based on dealer position, we're flat Monday. I don't think Monday is gonna have a ton of price action unless we slip below 280. Tuesday we have jolts. I think that could rock it a bit, rock the market a bit. So I would say Tuesday we could see 250 again. I agree that if we don't just bounce off of that, then your projection for 41.50 isn't so bad, but I would say it's probably closer to like 41.30 into the end of the week. If Jolts isn't bad, I think we could hold this range until the end of the week. I don't think a lot comes after that. There's some volatility with like a Powell speech that's possible. We have ISM services. Non-farm and unemployment on Friday could be very big. So
Is the Powell speech going to be just a Powell going to the open mic at O'Doul's Irish Bar and singing his favorite Grateful Dead tunes?
I really don't know. But I would say if Jolts isn't bad enough, Jolts is meh, then unemployment could be. And these are the two big breakpoints for the week. Both of which could see us move substantially below 42.50 if they're bad. As far as the upside's concerned, I don't think I still think there's issues with liquidity and larger potential moves. I still think we're kind of capped at like 43.50 still. I don't think we see delta neutral this week, even with the government shutdown being pushed off.
Yeah, no one actually gave a shit about that.
Yeah. But we'll see. We'll see what futures open tonight, how the market reacts. I would say if we're gonna have any upside, tomorrow's the most likely day for it. But I think ISM can just kind of crush that, especially if like manufacturing prices are up, because that's going to be like forward indication that PPI is going to be up, right?
Yeah, the market's still digesting. I think
Yeah.
there's a
Also don't forget that, you know, all of the PCEs have been reweighted to be way worse over the weekend. So even though the Fed shutdown was avoided, PCE now looks terrible all through 2023.
Yep.
So I'll try to be more specific. Tomorrow, let's say we could test 4,300 again. Tuesday, 280. Was Tuesday jolts or Wednesday jolts? Fuck. I think
Shit.
Wednesday was jolts, right?
Next week, what do we got?
No, Tuesday's jolts. Shit. So Tuesday Tuesday we could fail 280 and go down. Although, yeah, you're right. Tomorrow, I mean, we're both just bearish. So
I
here,
mean, yeah,
yeah, Dork end of week 41.50, right? Me end of week 41.30.
yeah. I mean, upside, I don't see it going much past, like you said, 4,300, 4,325.
Yeah,
Absolute top, I think. Like if Jolts is flat and the market just is still just in this point of desperation to just keep equity prices inflated, we could just trade flat all week. I think that's a very real
I
possibility.
mean, I think that's the problem with this week is directionality is always really difficult, and it tends to lead to pumps because liquidity dries up, right? Like put buyers kind of walk away for a little bit because none of the data sets are important enough. And so we always have these 2 weeks of lag before we hit SLD where like anything can really happen. Um, so I wouldn't take these predictions with a lot of merit, and I think the wisest approach to this period is always to play it like day by day. I found myself to be far more successful playing this specific period of market data on a much shorter time frame, and then accumulating longer time frame positions as we approach SLD OPEX. Um, and that so far that's been working pretty well for the last like 4 months. So yeah, I think things are overall bearish. We can net bearish for the week, but playing it by ear is important, and keeping your risk minimized is more important than anything because they
Yeah,
can they can turn it around if there is sharp capitulation in any short side. We can bounce, and we can bounce really hard, right? If we move down, I guess this is probably the most important thing about our prediction. If we move down to like 240, right, and we get capitulation, we can move all the way back up to like 43.35. Like the range here is very wide.
yeah, yeah. It's we could either be, yeah, super range bound and nothing really happens, or yeah, we see some volatility pick up. And like you said, with the lack of important data, we got some Fed speeches, which maybe one of them says something crazy, but like that's a big gamble. But if put holders don't capitulate and they decide to double down because all of the prior data is really confirming to the downside,
Yeah,
then and we break that long-term uptrend, then I mean that's a huge confirmation for the bears, and we may see a lot of confidence enter to the downside. But you're right, if we don't break that lower resistance, then yeah, there's a very good probability that we just bounce our faces off and we go right back up to the top of the range. We just sit
yeah,
there.
and that could lead to this week being very much like last week, right? And then unemployment comes in, and we kind of just end up where we started. Um, so yeah, keep that in the back of your mind, and that is a product of our net negative gamma environment, right? So we're so far below like delta and gamma neutral that everything's very negative, but that also means that upside moves the market maker is buying into. So they're selling the down, buying the up, right? And that means that all of our price action is going to be within a greater range inherently.
The marble on the bowling ball.
Yep. All right,
Yep.
Doric. Thank you so much for hanging out, man. I appreciate it. It was a good talk.
Yeah, for sure.
I
I had
think we
fun.
covered a lot of ground. So,
I think we did too. Hopefully somebody learned something. Oh, thanks
um,
for having me on, bud.
you got it, dude. I'll see you. I'll see you maybe later today if you're down for some PP touching.
I'm always down to touch peepees.
Nice.
All right. Later, bud.
Later, dude. All right, guys. Thank you so much. Sahib, you don't get a fucking another song because you dropped Dillionaire and resubscribed in the same month. Fuck you. Um, where's Jfresh to balance out the Bears? He's injured and resting in his cave. I appreciate you guys hanging out and listen to me and Dork circle jerk economic conditions. Always fun having you all here. If you guys have any questions, I'll be hanging out on my computer for kind of the rest of the day. So hit me up, moderately in DMs if you didn't get any of your questions answered today. And I will have Pickles picks out tonight and kind of an assessment of the options market conditions going into tomorrow. Remember to pay very close attention to the updates every night this week, because this week and next week are both they're kind of fucking screwy because we don't get a lot of big data, and everything kind of falls onto positioning even more. And without the data to kind of skew positioning, this is generally the period where we get the craziest moves in the opposite direction, right? So be very careful of that. And I will keep you guys updated throughout the week. So thank you so much. Enjoy the rest of your Sunday, guys. Later.